Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's December 6, 2019, episode 57. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we're going to be joined by Dave Floyd from Aspen Trading Group. And then we debate how much the 2020 presidential election might be affecting the market.
In this week in trading history, we're going to go back to 2008 when the National Bureau of Economic Research officially announced the economic recession, and then we'll get to the top 5 things to watch next week. So, Lena, jump on here. Who is the show brought to us by this week?
So this week our show is brought to you by Lock Street Brewing Company's Portside Pilsner.
All right, what are we about to drink?
So it says traditionally brewed with Canadian Truro barley, a surprisingly clean and crisp beer with a hint of, I don't know if I know how to say this word right, Satz hop. It's not a sour,
nice.
so we'll see.
Oh my God,
You know what?
Nice. I like it.
This is the most normal tasting beer we've had like in a month on the show.
It's just awesome, though.
It's almost refreshing.
It's refreshing that like you don't feel like you're biting on a lemon.
Like I
Anyway,
could drink a
it's-
pitcher of this probably.
Yeah, you could order this, but yeah, this is sessionable.
you could
can-
and will.
Yes,
That's right.
This is actually pretty good stuff.
It
All
is
right,
sessionable. I agree. Okay, let me do my legal
Kev,
stuff.
disclaimer, buddy.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include false range expansion delusions, silent FOMO ache, and or rooster breakout malaria.
I don't want to suffer from any of those, so
Yeah,
I'm
I
gonna
don't
take
either.
it easy on the huddle this weekend. All right, so let's get on with the show. So joining us now on the Market Huddle is Dave Floyd from Aspen Trading Group. How you doing, Dave?
I'm doing fantastic, Patrick. Yourself?
Oh, I'm very good. We're just enjoying this Portside Pilsner lager over here. Are you going to join us for a beverage today?
I will be having a beverage in a little while, and I'm also going to keep it with a north of the border theme. I'm going to be cracking open an IPA out of Victoria, Canada, and I'll reveal that a little bit later.
Oh, nice. All right, so let's jump right into it. You're a tactical trader. What's on your mind? You sent us a little chart book of some of the things you're looking at. What do you want to start with?
Well, you know, it's a good place to start because I can kind of give you and your audience a sense of how I approach things. I tend to keep a very narrow focus on what I trade. Going all the way back to my early years when I started off briefly as a floor trader, then I was an upstairs electronic trader. My edge has always been on focusing on a handful or even one or two instruments and knowing those instruments very intimately. And I still take that approach overall. You know, I don't really trade much more than 4 to 6 markets on a consistent basis. When I look at some stock ideas and whatnot, they tend to be a little bit longer term, but that's when I kind of employ the help of, some of my colleagues, business partners and whatnot to kind of frame those trades. But my point being is that we could have this conversation 3 weeks from now, and I'd be looking at the same markets. I'd be looking at, largely speaking, 10-year notes, meaning via the futures market, S&P 500 futures, and then a handful of the G10 currencies, mainly Euro, Aussie, Kiwi, Euro, Sterling, dollar, yen on occasion, and one of my favorite currency crosses to trade is Canada yen, oddly enough. But it trades very well, good proxy for a risk-on market. So that's kind of my universe. And I find that when I deviate outside of that universe, my level of understanding relative to other people who are really focused on that is far less than what they have. And I just don't do quite as well. It's just a style that suits me best, is to remain laser focused and try to get that edge.
Well, makes sense. So what's your thinking on the treasuries then?
Right now, I'm kind of neutral on treasuries. We're coming off a really, really good week. If you want to scroll down to that next 10-year note, that 4-hour chart, again, anybody can say this in hindsight, but this actually did happen. We actually got long 10-year notes back around November 8th, and we basically sold them up around the top. We actually sold them around the top, covered them around that end of the November, right ahead of Thanksgiving. And then we recently reestablished longs and closed them out at around 130. So we've had 3 trades in 10-year notes in the last couple of week and a half or so that have been rock solid. And this sell-off that we have going on right now is just kind of putting me in pause. And the other thing as a trader is when you're coming off a pretty good winning streak, you don't want you want to make really sure that you're not letting your feeling good about your own ability get the better of you. You can sometimes get a little bit careless. Because I remember I was talking to my wife yesterday, as a matter of fact. I was like, yeah, I'm looking to reestablish longs in 10-year notes. And she's like, you just had 3 really, really good trades in a row. Not saying that you're not seeing the market correctly, but sometimes when you get that winning streak, so to speak, you get a little too full of yourself. Just the same way when you have like 3 or 4 losing trades in a row, you get gun shy, which is when you kind of need to step up. So to go back and answer your question, I'm still overall bullish on 10-year notes just based on the wave count. And if you go back to the daily chart above there, I can kind of walk you through my overall bigger picture view. It looks as though we've completed a wave 4 correction back in early November, late October, early November. Whether or not wave 4 is complete, that's becoming a little less clear now after today's sell-off. So I want to wait basically for more evidence. I'm in no hurry. I don't trade for entertainment. If you ask people who've known me for a long time, they'll probably tell you I'm the most patient and most selective trader they've ever seen. I can sit on my hands for days on end, and that does not bother me. I don't have that fear of missing out.
So Dave, Dave, like I totally see what you're technically where you're going at. Like that was that impulse move higher, and we're in the midst of some sort of a zigzag consolidation of that prior rise. And I actually have been calling a very similar style pattern. The one thing though that I've at least always noticed is that when we get a move like what just happened on Monday, where you have this big breakout candle come in. Usually, Kevin likes to call him almost like a prairie dog, is what we have a little fun calling these things. But when a market breaks higher like that, usually I look at that as a very important clue, because if it was ready to be bulled higher, that should be the advertisement to the bulls to come in there and start taking and establishing the new uptrend again. And whenever you see a pattern where it slams higher like that, and it says, "Listen, we're gonna go and make a run for a new little bit of a higher high," and the sellers just give it to them and wipe out the entire advance in the subsequent days. That kind of false start is actually, in my mind, relatively on the short term negative. And I understand where you're coming at from a neutral perspective. Do you think, we're going all the way down to like 128 or 127? Could there be one more, like a little drop in consolidation where we see yields pop before this thing turns again?
Oh, yeah, very, very much so. First of all, I agree with your premise. Again, it's just kind of, general logic. If you can't get the bulls all frothed up and then they get whacked down on the NFP number here, that does say something. So could we go back down towards 128, maybe 127 for sure? One of the things I look at very closely is the yield curve spread between the 2s and the 7s. And right now, the way the 2-7 spread, and I think I have a chart in there, it might be the next one down. Yeah, right there. To me, it looks as though we could still go a little bit higher. And if that spread does go higher, it's inversely correlated to 10-year notes. So that too adds to, I don't want to say a neutral, but my overall theme is that it's a bullish wave structure overall. So I'm kind of neutral on placing trades, at least in that direction at this point in time. But in the short term, like you said, yeah, we could potentially move lower. It's not a trade I would take because I don't think there's as much meat on the bone, so to speak. So I'd be more inclined to, if we can get that 2-7
Yeah.
spread get up, let's say towards 1882, the upper part of that Bollinger Band, then I might start getting really interested in seeing if we can find some sort of traction off the lows and 10-year notes, and then I might be willing to get long. But for right now, yeah, maybe on the downside if you're really quick, a short-term trader, there's probably some more meat there, but not for someone like myself. I want something with a little bit more up or downside depending on which way I'm playing it.
So
Dave, it's Kevin. Oh, actually,
okay,
Patrick,
go.
can I just jump in here?
Yeah.
I have one question for you, Dave. You mentioned that your wife was chatting trading with you, and I just thought that was that's a great kind of partner to have. You get to sit around and talk markets. Is she in the industry as well, or is she just kind of watched you trade for all these years?
Yeah, no, she's not in the industry. She's actually in the public health industry, and runs a nonprofit medical clinic here in town. And but she has a perspective that I don't have at times. That's not trading related, and she's just kind of got a good sense about her. And we actually talk. She wants me to talk through the trades, what I'm doing just about every day. And I find it really helpful, and I'll tell you why. There's a colleague of mine, you guys that might have even interviewed him, or some of your listeners might know of him. He's a big Elliott Wave guy. His name's Andrew Baptiste. And he used to be the head technical analyst over at Morgan Stanley. So, pretty big role. And he said to me something years ago that I thought was really, really good. He goes, there's two types of people out there. There's great analysts and there's great risk takers. There's very rarely do those two come together in terms of being, both being really good. There's a lot of people in the middle, and I'd kind of consider myself in there. I'm a great analyst. I'm not the best risk taker. My wife sees it very differently than I do. She's always saying, you're not sized properly on that, because she understands the whole mechanics of position sizing, drawdowns, and all that stuff. And she'll say to you, great trade, but man, you weren't sized properly. And I was like, well, X, Y, and Z. And she basically holds my feet to the fire.
She's your George Soros telling Druckenmiller to be a pig.
Exactly.
Okay, so Dave, I have one question about the 2-7. Why do you use the 7 as opposed to the 10?
That's what I was
Most
gonna
people
ask,
use, most people use the 2-10, and you're using this kind of not the most common of yield curve spreads.
Well, I wish I could claim I don't have any. I wish I could tell you that I stumbled across this, but I got a lot of colleagues who are in the fixed income market at a pretty high level, either bank traders, running hedge funds, or whatever the case may be. And I can't remember the exact reasoning. Again, I'm a trader. I'll take whatever works and utilize it. I don't necessarily always understand the how and the why behind it. But they were saying the 2-7 spread is as a far better gauge of what's happening in the 10-year note market than the 2-10 spread. And there was some reasons behind it, but all I was interested in at that time was what's the kind of the empirical evidence of how that's correlated, whether it be positively or inversely. And the 2-7 is definitely, for me at least, a better spread to watch.
Well, that's a great tip. I appreciate that. So let's go to the next chart. What do you got for us as well?
What do we got here? Oh, CAD yen. Again, I love trading this currency. It tends to be a kind of a risk on, risk off. You could almost view it as a proxy for the S&P 500. So, if people aren't comfortable trading S&P 500 futures, which I can completely understand because they're manic, CAD yen might be a better way to do it. And what's interesting to me here is that I'm actually kind of puzzled. I'm long this from just over 82 this morning because with the S&Ps being pretty firm today and kind of having that nice pullback off the recent highs, I'm thinking, I'll nibble on CAD yen. It should move higher. It's been kind of just the opposite today. I think the big move up in the Canadian dollar today probably offset a little bit of the impact of the S&P 500, but either we get some traction in this pretty soon or I'm probably wrong. Obviously, my stop's down there at 81.54, but if we can't get some traction soon, I might cut it early. But my thinking is as follows: 5-wave move up, a little bit deeper than I would want to see on a wave 2 pullback. And if the S&Ps continue to move higher, which I suspect they will into year end, because that is my overall thesis, this one should get dragged along. Looking at some of the option stuff that I look at on the Bloomberg terminal, I would say that, I have a tactical price target on this one of about 83, just from a technical perspective, doing simple wave measurements and then projecting from where I believe the correction will end. And I come up with it about 83, running that same price target through an options model on Bloomberg. We got about a 42% chance that we'll head towards 83 within a month. Now, again, those aren't great odds. I'd love to see it at 60 or 70%. But if you look at what the price action was today, that's probably a contributing factor. Risk reversals are also skewed pretty heavily bearish. I'm kind of hoping that's a contra indicator. So I'm still looking for this to go higher, but not off to a good start so far.
Well, Dave, you're probably going to trigger Kev over here because he's shitting on Canada pretty hardcore, and I think that
but this is Dave's a trader, so he's trading the price action. So
no, that's what he's doing for sure.
Yeah,
but I'm surprised you weren't triggered there, Kev.
Well, no, because I respect those who trade the price action. I'm not gonna.
What are you down on your home country for? Is it Trudeau?
Oh, I know you
something.
Yeah. Well, I'm very bearish on Canada. I wrote this blog post, and I got all these other people from other countries telling me why I'm wrong about Canada. And I realize it's one of those things that being a home, your home country, you always see the worst of it. But it seems to me that there's for the last 6 years, we've been doubting I don't know. We've kind of had this situation where we could do no wrong. Canada just seemed to be bulletproof. Our banks were bulletproof, and a million things that we just seemed to be the apple of everybody's eye. And we kept going higher and higher and higher. And even those that were negative on it and were shitting all over it, they've actually, some of those kind of high profile shorts have actually capitulated and have just given up trying to short Canada. And it really feels to me that they're giving up at the very time when Canada is about to roll over. So I have all sorts of fundamental reasons why actually I think that the CAD yen is going to do the exact opposite of what you're looking for on a kind of a trading perspective. But those are different time frames. So that's why I didn't want to jump in, Patrick.
All right, so you're trying to be nice to Dave. That's okay.
Those are really valid points. And again, not only do people have different views on the same time frames, but you get different views that are expressed at different time frames. And I think your argument, actually, Kevin, I think is accurate. I've read similar articles. I've not read your blog post, but it does make sense that at some point things could get a little dicey. Things will get dicey here in the U.S. I mean, it's really astonishing how long the recovery overall on a global basis has gone on. And I'm not smart enough to figure out when it'll end, but common sense tells me that at some point it will, and I'm hoping that I'll recognize it.
Right.
And CAD yen probably would go lower if the shit does hit the fan. Guess what? You're going to have that the run into the yen, the safe haven trade. So your theory under those circumstances would elicit a lower CAD yen, and I would completely agree. And I would hope at that time that I'm looking at the market from my perspective and saying, looks like shit's about to hit the fan. I'd like to be short this. But for right now, I think you guys are going to wake up tomorrow morning and things will be okay.
Right. So, Dave, I have a question back to the 10-year note. And you were talking about it, and it reminded me of rangetrader.com when you and Patrick were talking about the high and low. I was wondering, what would it take for you to get bullish again? So right now it's kind of in no man's land. You're just watching and waiting. What would be the signals? Like, what would be the triggers that would cause you to buy it again?
Well, there's a couple things. And of course, as you get closer to that point in time, there's a lot of, given that I'm primarily a discretionary trader, there's a lot of intangibles that can come together at that point in time. But, for those listening that are kind of looking to go through a checklist, which I think is really important, you should have a basic checklist that defines your overall trade. For me, there's a couple. A pullback into an area that makes sense from an Elliott and Fibonacci perspective, meaning that they line up, it's consistent with how you would see these things unfold. If I was still a little hesitant and not really sure, I'd want to see a minor degree 5-wave impulse off of that low. That indicates to me that there's buying interest that is quote unquote impulsive in nature, and that will probably tend to be sticky. The big thing for me, again, going back to the oddball 2-7 spread, is get that 2-7 spread up into the upper ranges, into that Bollinger Band, and then I'm going to be really, really looking for a reversal of some sort, because the tendency is when the 2-7 gets into those upper ranges, like everything's mean reverting, and that 2-7 spread tends to mean revert. I'd be looking for something very similar again, which would be bullish 10-year notes.
Yeah,
Right.
and Dave, if I can just add to that, and you can tell me whether this lines up with your thinking as well, because I do a lot of Fibonacci's and things like that as well, and Elliott Wave is a strong anchor in terms of the measurements. The entire advance that we had throughout May through September was that impulse move higher, and every time a huge rally like that occurs, the market goes through a period where it backfills or consolidates. Those come in different patterns, and obviously that's where Elliott Wave and Fibonacci levels come in for that. And so far, at least in my mind, the entire consolidation off of those summer highs has just been backfilling such an enormous rally. And really, it's all about just discovering where and how the consolidation finishes. There's a lot of the bears out there are trying to already rush to call that a double top along the top end. I think that's very premature to be already calling in the top. Like there's no shortage of the Kevin Muirs on Twitter that are already sure that the major tops are. I guess you can look at the German yields and see some signs that global yields may have reached a peak point. But I still think that there's plenty of room for this to bullishly break higher. But anyway, that's my interpretation. Does that sound? Does that kind of work in line with the way you look at the markets as well?
It does, and it allows me to kind of throw in my macro viewpoint, my quote unquote novice macro viewpoint relative to others in the industry. The one thing I've learned being in this business 25 odd years is, the Fed, you may agree with them, you may disagree with them. I happen to disagree. I think there's a lot of ultimately problems that will come from all this tweaking and this monetization of debt and blah, blah, blah. But the bottom line is you can't fight it. And we're nearer the end of an economic cycle than the beginning. So the idea of rates moving dramatically higher just seems kind of not logical to me, absent some sort of an inflationary breakout, which that doesn't seem to be in the cards. So I agree with you. I just think we're backing and filling here. And this is where most newer traders get themselves chopped up. They don't recognize the environment that they're in. And as a result, they keep deploying the same strategy in the wrong playground, for lack of a better term, and they don't get the results that they would expect. You have to understand, obviously, trending versus non-trending market, and kind of knowing what tool to pull out of your toolkit, or more importantly, how to play that particular market. You can't play that for the extended moves. And like you said, ever since early September, we've basically we've gone slightly down, but basically we've chopped up and down with a slight downward bias. That's not exactly the best environment for traders unless they've got a really good feel for the market and a really good sense of what we're doing relative to where we've been. So I completely agree with your premise.
Right.
Okay. Good. Some wise words there, Dave. So you got one last trade for us, and I guess is it U.S. Steel? Is that what you brought some charts along? Yeah,
that is U.S. Steel, and this is one of the things that I look at from a longer term perspective, and I'm relying upon some colleagues. I've got a new. We'll talk about this a little bit later, but I got a new I'm actually setting up a new company in Toronto, of all places, with a business partner of mine up in Toronto, and he's really big on more of the stock analysis. That not an area that I focus a great deal on. But what we did with U.S. Steel is we looked at it from a technical perspective, and we're also looking at it from a quantitative perspective. And I think it's one of those things where, again, if you can check a lot of boxes that suggest your view is right, again, it doesn't guarantee success, but it helps you avoid trades with a very flimsy backbone, so to speak. So,
Right.
we're looking at not only the technical backdrop of U.S. steel. I think at minimum we go to 1550, but I think that target's really, I think that's a wimpy target. I think we go much higher. And this is a trade that could last weeks, months, if not a little bit longer. My upside target on this is probably closer to 19 to $20. And
Nice.
technically that supports it, but also from a quantitative standpoint. Some longer term moving averages that we look at would suggest we probably get about almost a 35% move higher over the next 3 to 6 months. That brings it up to about 19 to $20. That's consistent with the technical view. And recently, if you look at the rate of change, the technical measurement rate of change, it's been at above 20%. That's a pretty uncommon thing. And historically speaking, when it's done that, you're looking at about an 8% return looking about 3 months out. So that probably takes it up another, $1 or $2, something like that. So we have the technicals and the quantitative. And again, going back to macro a little bit, I think the market got a little flat-footed with this whole inverted yield curve and recession fears back in October. And I don't see any signs of a recession on the horizon. And the steel stocks have been beaten down so badly. It just looks like a pretty good reward to risk relative, just basically a good risk reward trade at this point in time. So we've been long for about 2 weeks now. We're long from 1320 or so. We're closed today, I think, at like 1390, almost $14. But I think we think we got a lot more upside there.
Well, there you go. Dave, thanks a lot for being with us. And why don't you tell people where they can find more about Aspen Trading and what you do and request information if they so want?
Sure. Well, I would greatly appreciate that if you liked what I had to say. One of the things that we do, or it's actually the only thing that we do, or one of two things that we do, I provide to my clients my thoughts and the analysis behind it, as well as the actual trades that we're doing here internally. So it's kind of not only informational, but it's educational. You're kind of learning by seeing what I'm doing. And it's not like some blind signal where it's like buy U.S. steel. It's like buy U.S. steel because of these reasons. And they can find out about that research that we publish. And we have it in two services. We do FX in one service, and then we do futures and stocks in the other service, or you can buy the combination of the two services. And of course, that information is available at aspentrading.com. You can do the first month at half off. So first month is for $75. That'll give you 30 days of access. And we also manage money. We also have a managed account program. And one of the things that we're doing with the new company we're setting up in Toronto, which is going to be under a different name altogether, we're going to be really focusing on just the money management aspect. And we're going to be really rolling that out pretty big in 2020. So you're going to basically, all the trades that we issue in our research go into our managed accounts, because we've got a lot of clients that are like, you know what, I don't have time to follow anymore. I was in a meeting, I missed that trade. Why don't you manage the money? So we're going to set up a new entity and go full blast with the money management arm, or spin-off, so to speak, of Aspen Trading. You can also find us at Aspen Trading 10 on Twitter. We got blog posts. We got a YouTube channel under Aspen Trading. So, and I'm also on Real Vision TV quite a bit. So if you want to find me, you can. And I'll probably also be up in Toronto in January, February. So maybe you and
A market huddle meetup
maybe.
is in order.
That's right. We'll have to do some beers. Well,
Yeah,
Dave,
well,
thanks a lot for being with us today. And make sure everyone stick around if you want to hear more of Dave in the after hours.
All right, Kev, it's time for us to take a dive into a story that you recently wrote on your Macro Tourist blog, and I thought it was really interesting. And we're going to talk election probability theory. And, you based it all off of that Ray Dalio and Paul Tudor Jones interview where they talked about this, right?
Yeah, a reader was kind enough to send me this video, and I've been meaning to write something about it, and not just this one topic. There's so much in this a kind of 45-minute interview that I'm going to have multiple posts coming out about it. But this one point that Paul Tudor Jones went, and he went through his thinking about what the effect of the extreme outcome of basically the policies of the far left, what they might mean if they win, and therefore how the market might have to kind of discount that. Well, let's just, instead of me explaining it to you, why don't we just play the tape?
Video, sorry, yeah.
If I think about just this next election and the difference between Donald Trump and Elizabeth Warren, we did this poll internally about where the S&P would trade if Elizabeth Warren became president. And then we took the bet, and then Biden and Buttigieg and Klobuchar, et cetera. And then we took the election probabilities. And so our poll said if Elizabeth Warren was elected, the S&P would trade around 2250. I think it's at 3050 now. But I'm just saying her policies probably would, assuming that they were implemented, probably would give you something like that. And then if you just take election probabilities, that would imply, if you anchor that, I think Buttigieg and Biden were like 2,700. Because again, they're going to come in, raise taxes. That's going to cause probably some economic contraction. So that would imply that Donald Trump, if he gets reelected, the S&P is worth 3,600. So as an investor, you have to have a view on the election because the outcomes are so extreme. I've never seen this kind of polarity in elections as we have now. And they always say, oh, well, it doesn't make any difference who president is. The markets rallied 53% of the time under Democrats and 52% of the time. It does make a difference. Ronald Reagan, when he became president, was a huge difference to the stock market. And I would say who the next president is also going to have a huge impact on the economy, the stock market, particularly asset pricing, because clearly asset prices today, whether it's U.S. stocks, whether it's interest rates, whether it's the dollar, it's all priced off of, in my opinion, a 5% budget deficit with this incredibly overly stimulative fiscal policy combined with this overly stimulative monetary policy is creating this U.S. exceptionalism that one day, like if we normalized our deficit to where Europe is right now, would have a completely different valuations for the stock market, valuations for the dollar. The dollar would be substantially lower, I believe. So this next presidential election and what policies they pursue afterwards, I think this one is going to be more meaningful than any one, certainly in my lifetime. So it's going to be really interesting.
I agree with you. So I'm mechanistic. I'm not ideological. I'm just mechanistic. So I do go through the calculations. And if you take the way corporate taxes would change, the undoing of that, that's worth 7 or 8%. Mm-hmm. If you take the changes in GAAP accounting, so changes in the taxes for corporations, that's worth about 15% of earnings, and it will therefore would drop it on the basis of that alone. If you take then the wealth tax is $2.8 trillion over 10 years, and so that'll have an effect. So it is, and then that doesn't have to do with regulation and the changes in regulation. I think we are dealing with the question, again, like the 30s. Is it populism of the left or is it populism of the right? And how's that going to work? And that's not just an American issue. It's a UK issue in Jeremy Corbyn. It's a UK. So we have an issue in terms of that politics will certainly matter to asset prices.
So Paul, in his Southern voice, explains to us what they did in terms of the math. And I know this isn't drawing pictures on a chart, Patrick, so you're not going to like it as much. It's actually doing some math. But I thought it was an interesting kind of concept that he went through. And he said, if the outlier event of that kind of either a Sanders or a Warren win is truly that negative, that means that if you discount that and then think about the other side, meaning what would the Trump win have to be to make it balance? And I actually came up with a number that was much higher than Tudor Jones. I actually came up with a number using.
Are you saying that Paul Tudor Jones doesn't know how to do math?
No, maybe I don't know how to do math. I had trouble with my spreadsheet. Maybe we were using different predictits, but just to kind of walk you through it, at the time when I did it, it was November 1st. Trump was trading at 40 cents. Warren was trading at 23. Biden was 14. Buttigieg, I don't know how to say that, 11. Sanders, 9 cents. Bloomberg is 2. And then everyone else is a penny. So then what I did is I put in the 22.50 for both Warren and Sanders. I put in for Biden and Buttigieg. I put in 2,700. I kind of assumed that everyone else would be unchanged. And then I looked at Bloomberg and I said he's probably maybe a positive. So I put in 3,200. Then to balance that, I realized that when you probability adjust it, that you would need a 39.42 outcome, which is what, 900 handles higher than at the time when they wrote this. And I thought to myself, well, that can't be. That's probably not correct in terms of maybe the reality is that a Warren isn't as bad. Maybe it's 20%. And maybe Buttigieg is only 10%. So I put in the numbers and I kind of changed them. I changed them so Warren was 24.54 forecast instead of 22.50 like Tudor had, and then I made Buttigieg and Biden 27.60 instead of 2,700. And then I adjusted it and looked at it, and basically what I came up with was Trump was 37.41. So
on the S&P, just so our listeners understand, we're talking about the levels on the S&P 500, which at the time right now is trading at 3,146. At the time
so
we're
now,
doing this. So
the interesting thing about this is that we could talk about the fact that that there's these two very large diametrically opposed outcome. One is you get somebody that wants to do a wealth tax, that's somebody that wants to do a financial transaction tax, that wants to go and raise the corporate tax rate, and then on the other side, somebody that's very pro-business like Trump. So the market is going to have trouble discounting this. Now, some people, wrote me back to say, well, the reality is the market doesn't think that far ahead, and there's no way that it's doing a proper job discounting it, and all you have to do is look at the Trump election, because the market hadn't discounted that at all. And I agree, but I still think it was a nice intellectual kind of exercise to go through that Tudor brought up. Now, the one thing I do want to, that I think is kind of something smart to think about is the fact that we can go and examine how much these odds have changed since Tudor made that presentation. So if you go look at the prices of the different candidates now, you'll see that Trump has moved up to 45, so that's a change of a nickel, so 5% higher. Warren is now down to 9 from 23. She's down 14. Biden is at 15. He's basically unchanged. Buttigieg is up 3. Sanders is up 2. Bloomberg is up 6. And then everyone else, it's just basically I zeroed that because the reality is it's a little complicated with these, the way that the predicted market works, that it actually doesn't add up to 100. It adds up to more than 100 because people are paying an offer. But anyways, it doesn't matter. The point is that when I put that into my model, leaving everything else the same, and I just change the odds that the predicted markets have moved, and I come up with a new kind of equilibrium price for the S&P, it actually means that it should be 63 points higher. And ironically enough, when I wrote the blog piece, it was only 43 higher, but I think today it's probably now 63 plus higher.
Right.
Now, listen, as I write in my piece, this is just back of the napkin voodoo. No, it's
a black art.
It's only one step up of the black arts. But yeah, but it is interesting to think about the fact that Bloomberg entering the race alone, to me, is worthy of the stock market having to rally, because he has a decent chance of winning the nomination, and he's probably going to be, at the very least, stock market neutral and not negative. And then in the meantime, you see Warren and Sanders. Well, Sanders is unchanged, but Warren has collapsed. And let's face it, she was probably the most stock market negative out of all of the candidates. So the fact that she collapsed is also, positive for the stock market. So, there's a million reasons why we're rallying, over the last couple
But it could be
weeks.
one of them.
But I definitely think that this is one of them.
So the question I have for you is this. Like, I'm going to say it naively because I don't know whether I'm asking a stupid question. You're about to tell me. Right now they announced that they're proceeding with like impeachment, and from what I at least saw just loosely reading, the odds of Trump being impeached actually jumped. I don't know what the exact number is, but it jumped considerably. And now, does that change that predict number for Trump? I mean, he may not. If he gets impeached, or at least the probabilities of him being impeached went up, his chances of winning must have to be affected going down, no?
Well, you're right, but then who replaces him if he does get impeached? Who replaces him on the right? You might even argue that there might be somebody that has a better chance of winning, and him being impeached is actually positive.
You think so, eh?
Well, I don't know. I'm not predicting that. I'm just saying that that's a possibility. So yes, of course, him being impeached will mess all the numbers up. But I wouldn't say that him getting impeached necessarily causes the Democrat numbers to jump significantly. I still
This is
think
when I'm glad to be Canadian. I don't have to deal with this.
Yeah. Well, no, but you do have to deal with it. And I kind of did talk about the fact that, and you heard both Tudor Jones and Ray Dalio talking about how politics is becoming an increasingly important part of the investing landscape in terms of how you set up a portfolio. And the one thing that you kind of if you're going to take anything away from this kind of exercise that we did, it's the fact that the two outcomes could be very, very large on either side. Very large.
The interesting thing I want to ask you though, like how were the numbers looking before the election of Trump? Because that was one of the most bizarre things where the market basically like puked right after the Trump victory, and then almost immediately rocketed higher. I mean, how was a model like this predicting the outcome of a Trump election back then?
Well, I think though back then you weren't sure whether Trump would be positive or negative for the stock market, and not only that, you kind of had to assume that Hillary was almost a shoo-in, right? Most of the models were saying that she was going to win, like in terms of the prediction models. So therefore, the market had kind of priced in Hillary, and it was so at that point it's unchanged because they're expecting that. And then the question is, how would you have determined what would the Trump's effect on the stock market be? A lot of people claimed, remember Mark Cuban thought that the economy was going to tank. All sorts of people said negative things. And I remember trading that night because it was a wild night. But I was why is everyone thinking this is so negative? And I got long too early and got run over, but eventually started making it back on the bonds. Because one of the things that I realized, I remember bonds went super bid, and I thought to myself, this guy is going to spend. And this is going to be, in fact, inflationary, and there's no way that you should be buying bonds.
And you were dead wrong.
No, that's not true. At the time, it was a great trade. I think that the bonds were up I can't remember. They were at 3 or 4 handles, and they finished the night only up 1 or 2.
You're talking like a little swing trade, right?
Yeah, I'm just talking like overnight because I remember that. It was a wild, wild night. It was a lot of fun trading. But so I don't think that it works quite as well to kind of go through that same sort of math, because at that time you weren't sure. And not only that, the market obviously wasn't sure what they thought of Trump and whether that would be positive or negative.
This time around into the elections, it really can go either way, right? Like, I mean, you could give give an edge to one side versus another, but
the real question is the pushback to this is that whoever gets elected can't affect the market as much as they think. So even if Warren gets elected, she's not able to pass the kind of draconian, measures that she's calling for. So therefore, the stock market's not as bad.
So you think there's a potential of a bit? Do you think there's a potential for a pretty big swing when the Democrats ultimately announce who their candidate is? Like, is there room for this to be a relatively violent for the stock market, or at least a short-term move. Not like
Oh,
obviously not.
I completely think that we're going to be watching every poll and trading it from one extreme to the other, because let's just say that they do elect a far left kind of Warren type candidate. I think that you're going to see as we get polls that show them winning or losing, the market will be forced to discount that as it moves around. And therefore, because the two extremes are so large, you're going to get bigger swings than normal. Let's just imagine that instead, Patrick, that there was let's just say that it was Bloomberg versus just another like Romney.
Right.
Like, let's just imagine it was Bloomberg versus Romney. The stock market would almost not care. Like, yeah, at the margin that there would have been some kind of up and down, maybe a little bit. But contrast that to Trump versus Warren, and you can understand why it would mean so much more and it would cause so much more volatility.
Right.
Yeah. So, anyways, I think it's interesting. I thought it was a great point that Tudor made. I really enjoyed his way of thinking about the markets, and I thought it was a really terrific, kind of thing that he did with his staff. I wonder, though, if he included everyone. He said did a poll. Was like the front desk person allowed to vote in the poll too? Who is voting on the poll is what I want to know. Because all I could say
I
is
almost
that's
choked
pretty,
on my beer when you were saying that.
yeah, because you know what? The reality is that 2250 is pretty catastrophic. I can't speak too much beer, but it's going to cause it to go down a long way. 2250, I think that's pretty bad. Like, I don't think that would be the case.
Yeah, 30% swing in the market's pretty steep.
And so, you know what, actually, Patrick, here's one last point I'll leave you with. One of my MMT kind of type followers gave me shit because he said that, in fact, that Warren and Sanders will be less market negative than Biden or Buttigieg because they're going to try to balance the budget. And I will agree with him. If you're listening, I will agree with your analysis in the way that as it pertains to the economy, that actually Warren and Sanders might in fact be better for the economy. But I think for the market, and especially for the initial reaction, the market will freak out at the other two.
Okay,
so
I'll agree with that.
I stand by my point. But I do, when I think about the kind of Buttigieg or Biden, and I hear them talking about balancing the budget, and it scares the shit out of me because I actually think, Patrick, that would be the worst thing for the economy.
Oh yeah,
and I know
I'm
all the
on
hard
that
money all the hard money guys are going to tell me I'm wrong and stuff. But like, meanwhile, our economy is doing well because Trump is willing to go for it. And that's why the U.S. is the strongest economy in the world.
We're already going on too long, but I would have wanted the conversation.
Patrick's like, please stop talking MMT. Please stop talking MMT.
No, but you know what? I'll actually agree with you. I think that the hard money guys are going to be wrong. I think that while I'm not advocating MMT, I certainly think that balancing the budget would not be taken very well.
Okay.
Anyway,
well, there you go. You heard it first. We'll make an MMT out of Patrick before this is all
Oh my God.
Okay.
All right,
let's
here we
move
go.
on.
It's time for This Week in Trading History.
Your favorite.
Right?
Your favorite, Patrick.
Is it my favorite?
It is.
I actually enjoy your WTF videos a little more than my talks, but anyway. It's almost
I just
my
like
favorite.
that we just get to press play and listen. That's the better part.
Yeah, that's the best part.
But that's what I do in This Week in Trading History anyways. I just kind of get you going and then just kind of go drink my beer. So I'm going to go back and drink my beer. Have a good time.
All right, you go do that. So listen, but I just wanted to really kind of go back and really put perspective on this idea that we're all waiting for a recession, right? And so it was, so going back in history, it was December 1st of 2008, not 2007. It was December 1st of 2008, where the National Bureau of Economic Research announced that officially that we were in a recession.
Right. And if we go pull up this, I shouldn't jump the gun. I'll let you go on, Patrick. Sorry.
So really what it comes down to And so let's just first of all, who is this National Bureau? So they were founded in 1920. It's a private, not-for-profit, nonpartisan organization dedicated to economic research, and they've become essentially over the last century, the authority that officially decides whether or not we're in the midst of a recession or not. And they have measured U.S. economic cycles going back to 1854.
Really?
Right? And they've been tracking them since 1920. And
I think
so
it's a beer drinking club is what I think it is.
it's a beer drinking club.
Well,
Because
that's just an excuse for them to
the
drink
cycle
beer.
turns every decade, so you've got a decade of beer drinking, and then you're like, oh shit, something's happening. Now we have to write up a little report. But anyway, they go and measure every one of these cycles, and they've looked at measured all the different business cycles, how many months each one expansion or contraction. Like for instance, the trough to peak cycles, so often are, 69, 70 months. There's different lengths of these, and we're right now, based upon their count, in the longest business cycle expansion in history, longer than the March 2001 to November 2001. And that has a lot of people, including me, kind of in that camp of, well, listen, maybe we don't have a recession yet, but it's clear that we're in the 8th or 9th inning of this expansion, right? You can't say that this can't last 140 months or 150 months, but by the length in itself.
Patrick, 1 second. Australia went 20 odd years without a recession.
Right, but now I think the U.S. is a little different, and there's a lot of history going back, and so to believe, look, yes, you're right. There is, just because it's a certain length cannot guarantee its end. I'm not going to try to fight you on that. Ultimately, there needs to be some sort of a catalyst that begins a new economic cycle. Anyway, the point is we're in the longest cycle history, but let's go back, and really this time in history, this is all about 2008. And it was in 2008, December 1st of 2008, where they released the press release that basically announced that the U.S. was officially in a recession. And what I want to first point out is what they define. So it says the NBER does not define a recession in terms of 2 consecutive quarters decline in GDP, which is the traditional metric. Rather, they say a recession is a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. And so they are not using just the GDP model, right? So that's very important to distinguish that. But the point I want to make is by the time that the data was released, that in fact the recession was there, the bear market was pretty much almost over.
Yeah. Well, like pull up a chart.
Right.
We
so
were 4 months away, right? 1 quarter.
Right.
Basically.
And so the announcement of a recession was essentially December 1st, right here.
Yeah, it was basically done.
The bear market was pretty much over, right? And
there was one last little
thing, and in fact, it was a buying opportunity by the time. Yeah. And so what I think we do is we spend a lot of time talking about whether a recession is coming or not. But the one thing that a lot of our listeners that are not veterans of the markets, because we have a lot of really smart listeners. Why they listen, I'm not sure, but but we have a lot of smart listeners. But for our newer listeners, the one thing that is common is everyone's like, a recession is coming. A recession is coming. We have to watch out for it. But by the time the official parties, and by the time you hear it on CNBC, by the time you hear all these people saying a recession is officially confirmed, it's not only been priced into the market. Like we're probably going to already be 6 to 9 months into a bear market by the time we're going to see all the data that these kind of people are going to turn around and say, oh, we're in a recession.
Yep. Completely agree.
this is why the smartest people in the room are using in macro a lot of leading indicators. They're looking for all of the things that normally characterize a recession and subsequently trade it that way many, many months, if not even a year before the recession is underway. And,
like a yield
this
curve inversion.
And a yield curve, like not that we've never had this conversation before, but the point being is that there's a lot of leading indicators out there that are beyond yield curve inversion, that a lot of the really smart people are looking for. And if you're waiting for the National Bureau to come up with the announcement imminently, and that you're going to make your portfolio adjustments then, good luck. That's all I have to say. That's probably going to be a buying opportunity by then.
Well, I don't think that anybody from the NBER is going to be coming on our show.
You don't think?
With you shitting all over them like that?
No, look, they're just factual. No, listen. If the mandate of the thing is to identify a recession officially, then you're going to wait for the information. They're not offering their service as a market timing tool. I'm pretty sure if they came on and they would say that this is not a market timing tool, us calling a recession. And
That's
I'm
true.
just all we're identifying and trying to help identify is the idea that you shouldn't be waiting for an official recession call to make your portfolio adjustment.
Got it. Well, thanks, Patrick.
Do you agree?
That's a great,
Do you agree?
I
Anything else
agree.
to add?
No,
All right.
I don't have anything else to add.
All right. Well, then it's time to move on to the WTF clip of the week, Kev. And, well, what do you have for us?
Well, you know what, Patrick? It was all over the news this week, and it was the Peloton. And for those who don't know, Peloton is that exercise bike that they stick an iPad on and charge you $6,000 for, and and $200 a month or something like that. I'm not sure. And
$200 a month?
I don't know. Maybe it's $100 a month. I don't know. I'm not sure. It's expensive though. It's not cheap. We should probably look it up. Why don't you look it up while I'm talking?
Lena,
Anyways,
can you look up how much it costs to do a Peloton?
Well, forget it. Lena's already got one. Have you got a Peloton?
Luke got
Lena?
it for her?
Yeah. Okay. So listen. So they had this ad, and it's been running for a couple of weeks, I think. Like I remember seeing this ad. It might even be longer. This ad where this woman gets a Peloton from her partner for Christmas, and it then profiles her next year doing this. And I've been watching this for a while, and I kind of thought at first that it was kind of a cheesy ad, but this week it just all of a sudden caught the attention of, let's just say, some people that didn't think it was a very appropriate ad. And next thing we know, the stock actually got 15% taken off of it one day because of this ad. Anyways,
Really?
let's just Oh no, it was a big deal. So and subsequently, a lot of people have made some spoofs on it. So I decided to do a little bit of a mashup with one of my favorite ones. So without further ado, let's just play the new WTF clip.
Okay, you ready?
Yes.
Now.
A Peloton?
A Peloton? My husband got me a Peloton for Christmas. Nothing weird about that. Thank you. You get me.
Give it up for our first time ride.
All right, first ride. I'm a little nervous, but excited. Let's do this.
Okay, my first ride. I'm a little bit nervous, and rightly so, because my husband got me a fucking workout bike for Christmas, and that's rude. Let's go.
5 days in a row. You surprised? I am.
6 a.m. Yay.
Rising with the sun.
That was totally worth it.
6 days in a row. Are you surprised? I am, but my marriage is still intact. Let's get on the bike. 6 a.m. My husband is sleeping soundly next to me, but I couldn't sleep a wink because what kind of sociopath gets his wife a fucking stationary bike? Seriously, what the hell? What are you trying to say?
Go Grace in Boston, 50 rides.
She just said my name. A year ago, I didn't realize how much this would change me. Thank you.
I am so unhappy. I hate my life. A year ago, I didn't realize how much this would change me. Babe, I want a divorce. Did you like the video I made you, babe? Here, these are for you. Divorce paper. Sorry, yeah, no, but you were a douche, so.
This holiday, give the gift of Peloton.
It's pretty funny, eh? You know what I like best about this, though, Patrick? Is that the actor that plays the man He is actually a teacher from Vancouver. And all of a sudden, he has just gotten the ire of the majority of the population. And the poor guy is trying to go around saying, I'm just an actor. It's not me. I'm not really this representing this. And I think it's kind of hilarious that he's doing this because, like, if you think about Leonardo DiCaprio, like, you don't, like, just because he plays the Wolf of Wall Street or the Great Gatsby, we obviously know that that's a character he plays. And that's not what
Some
he's
people
like.
actually thought that was real.
I don't know. Although now that I think about it, maybe Leonardo is actually like the Wolf of Wall Street and like the Great Gatsby.
Maybe.
And maybe those are actually good.
By
But
the
I
way,
just thought it was, yeah, go ahead, Lena.
It's $40 a month.
Oh,
so
I
the
got it
bike
wrong.
started about just
It's
under
$40 US, which is about
Yeah.
200 Canadian.
Yeah,
these days.
exactly. Bikes start at about like just shy of $2,300, and it just goes up and up and up, and it's $40 a month.
Yeah, but so then you're probably thinking that if you finance the bike with the monthly thing, that's where you're getting.
Maybe. I don't know.
Yeah, locked
But
in it for
$40
8
a
years.
month. I mean, that's what people pay for their cell
Gym
phones.
yeah, or their gym memberships.
Yeah. Well, just to
Anyways.
get online and ride a bike with someone.
It was pretty
That's
funny
crazy.
though how this ad got a life of its own, and it's like, you know, it's not the greatest ad, but it's pretty funny how it's actually affected the stock market.
Yeah, but you know that stock has been ripping. It IPO'd obviously, and it's ever since that earnings announcement, it basically went from doubled. It went from like $23 almost to 37. That's not a double, but it's pretty much a pretty high end double digit return. And the interesting part is that it's one of the IPOs that's held up, right? Like the rest of them shit to bed. But the thing is that I remember reading it. Now I wish I had the stat on it, but someone was saying that some absurd amount of Americans, like I don't know whether it was like 10, 20, 30 million Americans would have to buy this bike in order to justify this valuation. I don't know what the number is, but I mean, when you give a $9 billion cap to an exercise machine company, I mean, you better be hoping they own the market.
Yeah, it's great.
Like, I mean, screw gym membership, screw everything. That whole thing's going. Everyone's just gonna have one of these bikes in their place, and that's it, right?
Yeah. So the reality is that it was probably due for a sell-off, and the ad was just an excuse to sell it.
All right.
So I don't doubt that at all.
What's
but,
your
like,
what's your over under that this thing goes beyond meat? Like after this run on the upside, that it's gonna give a chunk back, like, and even be under its IPO price.
Oh, I think it's very good chance. Like in what time frame?
Well, I don't know. I'm not even specifying a time frame.
I'm
it's
a
just
seller. Like these fat stocks. You know me. I'm just like they're always so much hype, and it's just a question of timing.
Like
I
I
have a
mean, like
question
when
for
you look at what happened with Fitbit and all of the other ones.
Yeah, it's just these things.
They
are
run
always...
for a little while while it's hot, and then they get hammered.
So Lena, I have a question for you. Were you offended by the ad?
I laughed at it.
Yeah.
But you're a good sport. That's why we hired you.
but I do have a bike. This is true. Not a Peloton
So
bike.
Lena, strap an iPad on the top, and you got yourself a Peloton.
I don't even need to. I just I have my bike and I have my laptop and I listen to Patrick's
Oh my
things.
God.
Trying to get away from the voice, and that's what gets me going.
Run away.
But my bike was
God.
not $2,000. It was $150 Canadian.
Nice.
So that's like $60 US.
Yeah. 32.
Oh man.
Okay.
That's funny. All right, but you know what? Look at a stock like Fitbit, right? I mean, after that IPO, it did a very similar thing, right? Like, I mean, it IPO'd at $30. The thing ran to about 50, about the same percentage return, and then just went from $50 down to like low single digits, like $5. Like you're talking about a 90% wipeout of its value. Actually, at its low, what it was like $2, $2.50? Yeah, 95% loss of the peak value.
The only reason it's up here now is because Google's buying them. Yeah, I hear you.
But the thing is that do you think that Fitbit chart is a good analog of what this stock will experience over the next couple of years?
100%.
There you go. That's you heard it here. The macro tourist has spoken. All right.
Okay.
All right, let's move on. All right, Kev. Top 5 things to watch next week. We reviewed last week, but last week was our Thanksgiving special, and
It's a
so
long
we just
time
did a
ago.
Q&A. And so
Yeah.
we just want to review what we talked about 2 weeks ago, but a lot of it is stale, so we'll just kind of quickly go through it.
Right.
Number one, let's start with number 5, Bitcoin. And, well, Bitcoin continues to just shit to bed. Like
That's a shock. It's
that's a
really
shock.
surprising. It's a revolutionary technology that's going to change the world. The blockchain's going to be on everything. You should buy Bitcoin.
But, you know, it's
okay. So for those who don't, this is your first show. I am. That's a little sarcasm.
Yeah. What?
Yeah.
What?
So what do we? I guess my joke's getting stale, but
Yeah,
$7,500.
it is.
Yeah.
But you know
And
what? What's amazing is that it first has a really big bubble, suckers everyone in, and then it has a little tiny little bubble over here, a little less pronounced, and it suckered people in a second time. You know, fool me
Jeez.
once. How do I put that Bush saying in there? Fool me once, and
I don't know. Why don't we listen to Bush tell him himself?
All right, let's play it.
There's an old saying in Tennessee, I know it's in Texas, probably in Tennessee, that says, fool me once, shame on you. You fool me, we can't get fooled again.
Anyway.
He's about as good with the words as I am.
Yeah.
So the reality is that Bitcoin, these rallies are meant to be sold. And every time it gets all excited, all they do is then bleed. I remember something about it was your book that you love, The Reminiscence of a Stock Operator, how he talked about how to really distribute something. The best way to do it is to run it up and then sell it on the way down.
Yeah.
And to me, that's what Bitcoin looks like each and every time. They get it run up and then they sell it on the way down, and that's it. Just looks to me like it's in distribution, and it's just headed lower. But heck, what do I know?
What do you know?
Okay.
Anyway, so
Facebook is way too long ago. Let's not worry about that.
Yeah.
But then let's go on to number 3.
Canadian banks.
Canadian bank earnings. It was actually an important thing to watch, and
so this is the XFN, which is the basket of the Canadian banks, but all 5 major banks. The money center banks here. Actually, there's 6 of them now. Did they not include National now in that basket?
I'm
anyway,
not sure.
But all of the major banks, every one of them gapped lower on their earnings. It was a miss right across the board.
And there's bad earnings, layoff announcements, credit write-downs, all sorts of shit. Like it's just not good.
It's not good. We'll talk a little more Canada a little bit later on, but anyway, this is not good. It is definitely on the radar as to whether or not this is a major turn point. It's certainly not a good sign that all of them shit to bed at the same time. Trade deal, nothing news really happened other than it's on, it's off, it's on, it's off. It's going to happen. It's not happening.
It's going to be, a year from now, we're going to have the same thing. It's going to be the trade deal, whether we're talking about it or not.
Yeah,
I do think, though, the market's become less and less sensitive to it, and everyone thinks that it's a big deal.
At some point, everyone just gets exhausted from it. Like you get desensitized to it.
Well,
and
the reality is that I just don't think it's as much a big. I never thought it was as big a deal as the market did.
Oh yeah,
I think that it's that it affects certain sectors and certain industries. But let's face it, this is there's been a wholesale fundamental change in the relationship between the U.S. and China. That is not gonna go back to the way it was. And the reality is, although that they might find a way to patch up something so they can trade a little bit more, the long and short of it is that we are headed into a point with much more trade tensions between those two countries. It's not going to get significantly better.
All right. Listen, I want to go to number 1. Now, look, the Thanksgiving Thursday was closed. The Wednesday was low volume. Friday was a half trading session. It was very low volume. Not much happened. But I just want to ask you personally. I have an opinion on it, but I wanted to know your opinion on that Friday. based on OPEC news that I didn't really think was that bearish, oil slams. I'm going to put on a 4-hour chart. Oil slams during that Friday morning session down like $3+ Do you
They
think
shot it. It was ugly.
It was ugly, but the question I have for you is: do you think it was because on the trading desk were nothing but a bunch of interns and young kids, and everyone else was out, and it was just a perfect time to slam it? Like, do you think that the low trading volumes had something to do with it, or am I just reading into something unnecessary?
No. Definitely the low trading volumes allow people to move it around a little bit more. But the end of the I don't buy this that it enables them to put it wherever they want.
Not put it where they want, but it makes more volatility because there's less defending the price.
Yeah, I think it had more to do with month end. I think someone big had to sell some at month end, and there was nobody to take the other side. Okay. That was my guess. That was month end, right?
Yeah.
I think someone chose to sell it at month end, and there was just nobody to take the other side, and it got ugly. And I couldn't believe it. I was long like an idiot, and then I thought I was looking around.
You weren't long like an idiot unless you sold at the bottom.
No, I didn't. I actually kept it,
then you weren't long like an idiot
but I guess because I wish I had bought it after that. But I remember I didn't even bother with the market on Friday. I was doing some errands and stuff, and I thought, oh, there's nothing that can hurt me that much. Nothing's going on, and then I go
and then you look.
I'm like, what the hell? Oil, this is what? It was down almost $3.
No, what's the worst for me is I got onto a plane to go out to Vancouver that Friday morning, and I landed, and like a time zone thing, I'm like, oh, it's 10 o'clock. I can still see the markets for a couple hours. But no, it's 10 o'clock out west, and the markets were closed. So I literally landed, and the markets were closed. I'm like, what the fuck? I was like,
because it closed at lunch or whatever.
Yeah. And so I literally got off the plane, and the markets were already closed for the day. It was like, what? That was the worst.
So you missed all the action.
Well, it probably helped me that I didn't unnecessarily click buttons.
Right. Okay. So let's go top 5 things to watch next week.
All right.
Number 5.
Now listen, I'm trying to intentionally jinx Apple here.
I'm trying to.
So
it's a goocher, not a jinx.
It goocher, jinx, whatever. I'm trying to goocher Apple. Look, the unbelievable that this thing gaps lower on that Monday, just gets slammed, and the buyers come in and rip it from the buy on dip traders come in, and they reverse it to 270 on the upside. This is a stock that is got some real activity, and the buyers are very motivated, and this is a lot of the characteristics of a stock that could go parabolic. And to me, I'm dying to find out whether this goes and rockets to some absurd number. I mean, look, it only has to tack on $150 to be the first $2 trillion cap company. Hey, that's nothing. It could do that tomorrow, right? No,
it could, kidding, but the reality is, Patrick, I'll take the other side of this. This is looking more and more like Prairie Dog to me. Last gasp, crazy shit. This is nuts. I think the silver-haired, cherry coke-loving octogenarian is gotten a little crazy with the blue tickets, and he's going a little nuts. And that eventually this thing's going to roll over, because the reality is that when a company is this big, and I get it, I understand it's cheap on a fundamental basis, but there's just a certain size that these things start to weigh on themselves, and just
4 or 5% weighting in the S&P. Only 5 stocks ever achieved that weighting, right?
Is that true? I didn't know that.
Yeah.
Oh, we should figure out what those 5 were. And
General Electric back at its peak, Exxon Mobil when back in 2014-15 or whenever it was. What were the other ones? Anyway, but there were 4 or 5 of them. They did Libowitz did an article on that, talking about those that did the 4 stocks prior to Apple that hit the market cap. I think maybe it was even Microsoft was one of them during the bubble peak. But anyway, the point is that each of them, though, after they reached that 4 to 5% weighting, they all spectacularly mean reverted. Like, I'm not saying that they all won GE like GE did, but they all massively gave back a huge chunk. But anyway, technically though, I'm not calling a prairie dog. You can prairie dog this one on your own. A stock that is like this, if the S&P is going to 3,300, there's nothing stopping from Apple from printing north of 300. But I understand that any listeners that don't misinterpret me as buy advice, because really you have to trade this tactically, because at any one moment when something goes parabolic, it can drop as fast as it goes up. And even if it could go to 300, it could be back at 250 just as fast. It's definitely where the action is, though, isn't it?
Oh, for sure. You know what'll be hilarious if after we say the trade deal is no big deal, that the Chinese come out and put a tariff on something for the Apple one. So not only does the trade deal be a big huge deal, but it gets crushed as the Apple.
Wow. Anyway,
because if you think about it, actually, it is interesting that you would think that they would actually be the most sensitive to a trade deal, because if it doesn't go through and the Chinese were looking to hurt the Americans, that would definitely be a company that would be on the top of their radar.
Yeah. Yeah. No.
Yeah.
Anyways, I agree.
Well, anyways.
Number 4. I'm going to let you go on this one.
The Canadian economy. Although the Americans had their, we both had our unemployment numbers today, and although the American unemployment numbers were terrific, spectacular, and very real, the Canadian numbers were terrible. They were awful. And so just to get a sense of how awful they were, we lost 70,000 jobs. Our country is a tenth the size of our American neighbors, so which means that's like the American economy shedding 700,000 jobs.
Wow.
Now, obviously, there is something wrong with our ability to forecast our unemployment numbers, because we were expecting like a 10,000 jobs gained, and it came out to 70,000 lost. Although I am bearish on the economy, I don't think it's that bad, and there's something wrong there. So I don't want to use this as an excuse to say, oh, look, I'm right, because the economy is shedding this many jobs, because the reality is that this thing is volatile, and they obviously don't know what they're doing. There must be a seasonal factor they're missing or something. We could turn around. There could be 50,000 back up next month. Who knows? Right. But back to you, we were just talking about the banks, and we were talking about how they're missing earnings. They're laying off people. I think that we're increasingly getting to the point in Canada that we are hanging on by a thread, just a thread. Our economy has been kind of growing through immigration and real estate. And although
and our central bank has not been giving us a mid-cycle adjustment.
Well, that's true. They have. You're right. And then so if you look at our GDP on a real basis per person, meaning like you adjust it for our GDP for population growth, we're actually stalled and haven't grown for the past year and a half.
Yeah. Which
technically means we're almost in a recession already on a real basis per person. Yep. The only reason we're doing well is because our immigration, floodgates are open, and we're building houses for these people. This is not a sustainable way to run an economy. And, a lot of pushback that I get on this is, well, if we have a reflation, Canada is going to be at the forefront of that reflation, because typically global economics expansion, Canada does well. Well, that's the case when we're able to sell our oil. Although Kenny, our prime minister, or the premier of Alberta, is doing a good job at trying to get the Alberta oil going, again. The long and short of it is that our oil energy economy is not enough to shore up our whole economy. And not only that, I'm not even sure in a higher kind of oil market that we're going to have a situation where the Canadian economy does that well. I just don't see it. Like, yeah, maybe they cushion the blow that we get from everywhere else, but I just don't see us rocketing off. We are no longer the petrocurrency that we used to be. We are no longer the kind of the first step in terms of selling everyone our stuff, because we've increasingly become nothing more than a bunch of people that are speculating on real estate.
Right.
And it really drives me nuts, because I wrote this article about the yield curve. I got huge flack for it, and I got all these people telling me about how, the Canada is going to do so well going forward. And I thought to myself, it's funny that there's been some very prominent bears that have finally given up on their bank shorts because they've realized that there's all this immigration. And everyone at the time when it seems like we can no longer ever go down again is the time when you want to be selling, not the other way around. Yeah. When there's all sorts of skepticism about the possibility that we go up, that's the time you want to be buying. When everyone's telling you for sure that there's no way we could ever go down, that's the point you want to be selling. And to me, it's becoming increasingly obvious that Canada is in this period. And although the global economy might keep going higher, Canada will be one of the worst performing on a relative basis.
All right. So, but is the performance? We've had this conversation before. Are you still on the camp that this could actually manifest in proper asset price drop, or is this a Canadian dollar story? Because I mean, I know you're bearish the CAD, but you think that this is going to directly hammer Canadian asset prices, like the stock markets and everything as well?
Yeah, well, first of all, I'm not that bearish on Canadian fixed income because I don't think that we're going to be suffering from inflation, and especially on a relative basis. I don't see Canada fixed income as anything to worry about. I'm not worried about the credit risk, but I am bearish on risk assets for sure. Our banks are priced for perfection. They've been rising for, even like they've been rising since the great financial crisis, but even before that, they've been rising like nobody's business. Canadians, the Americans hate their banks. Canadians love their banks and love their bank stocks. And everyone is stuffed to the gills with these kind of proxy plays. I think that Canadian bank stocks are some of the scariest stocks out there. Yeah. I think they're priced for perfection in going into probably a slowdown in the economy that is going to, with a consumer that is way over indebted, and the banks, all they need to do is just have to allocate more credit reserves, and you're going to find their earnings drop. And I've heard all this crap about the reality is that the banks have lots of extra space to cut headcount and stay profitable. Well, that very well might be. I'm not disputing that. And we saw that with BMO laying off 5% of the workforce. So we're already seeing that. But how is that going to be good for the Canadian economy? How can you be bullish on these things? We are entering into a self-feeding loop on the negative. And I'll stop ranting, but I just I love the trade. I love the trade. I love shorting
short
Canada.
Canadian banks. Let's do it. All right.
Canadian banks short the Canadian dollar. I think you got to short Canadian dollar against I love shorting Canadian dollar against owning the yen, against owning the British pound, about like a million things like that. I think there's such better places to put your money than Canada, where everything, don't get me wrong. I'm not like an end of the world, like somebody who once said that commerce, he was going to cover his short at $5. Well, the reality is that I don't think he covered it at $5. And I'm not saying that that's the sort of decline we're going to see, but I do believe that these things are increasingly have a lot of optimism baked in and not nearly enough problems, or enough kind of, let's just say, safety and margin. And so I think, okay, listen, we got to take a pause here. We have a little, like a kind of a, what would you call it, Patrick? A way to talk on the, like a instant messenger. Yeah. Lena has just told me that I need the trading couch. She's interrupting. She's saying that I need the trading couch. Okay, I will stop.
We need to lie you down on the trading couch.
I will stop with my thing.
And you're gonna,
I just feel.
Dr. Ceresna is gonna talk you through your Canada problems.
Yeah, no, but anyways, I think it's a great trade. But anyways, I'll leave it at that.
You know what though? What is an interesting thing is that I've tried being bearish Canada, and I've been early a number of times, way too early. I mean, I did sort of get the top of the Vancouver market right and a couple of these things, but I mean, overall, I thought a lot of this would start unraveling at the seams a lot sooner than it has. And what's interesting is emotionally, I've lost the motivation to short Canada, because I've touched that stove so many times and got burned that it doesn't feel as appealing to me. And maybe that's actually a sign that this is it.
Well, maybe you're right, because that is interesting that you say that, Patrick, because that is what I feel. I feel like the people that were the most bearish before have given up at the point where it actually, to me, feels like the best part, like it's the best risk reward. So it could be like that old Don Cox
and that's why I find what you're saying really interesting, because my enthusiasm for this narrative has weaned, and maybe that's actually a sign that I should be revisiting it. Anyway, listen, we've ranted on this. Let's move on.
Yeah.
I'm going to keep the next one shorter because like a 10-minute rant is enough. Number 3 is that did this market correction. Is it over before it even got started? What I find fascinating about this market drop, like I was talking about with members, and I think you get my morning notes, never read them though, right? I've been looking for like a 50 to 100 S&P point drop, just as a market correction from an overbought state. But what was amazing to me was that this market drop that happened at the start of the week literally happened within 24 hours. Like this will drop. This is 4-hour charts. This was Monday we started selling, and Tuesday before the market opened, we were already down, at 85, 90 S&P points off of the low. I mean, it literally took one day to clean that out, and then the market brushed it off, immediately got bid, and we're approaching previous highs. I mean, is it that simple to market correction over in that short of a time frame? Like, I don't know. I understand the stock market can go higher, but that's crazy. Like that happens that fast. You think? What's your bias? Like, you think that the market can just rip here?
Yeah, I listen. I don't think it will. I think we're actually going to have a period where I like Barton's work where he talks about the liquidity, and I think that a lot of this what we've been seeing can be explained with the Fed goosing in front of the goosing the liquidity in front of the tax number on the 16th. So I think that we could see some more chop going into that period. I know a lot of people will argue that because they're putting in that liquidity that the 16th isn't going to be a big sell day. I'm not so sure. I almost wonder if it's a situation where you get some kind of juice in front of the number, and then when it comes out, then it comes off, like as the liquidity comes out of the system. Doesn't really matter though, Patrick.
Do you think that
it's getting scarier.
The option expiration can pin the market into the 20th, like into the monthly expiration?
I don't know. The other thing is, Patrick, is that we're going into a year when a lot of people are up, but then some people aren't. And it'll be interesting to see if anyone wants to do anything. And in the case where it gets thin and illiquid, like we talked about in oil, if there's an order to do something, it can move it a long way. So if somebody big comes in and says, you know what, we got to get invested for year end, this thing could just rocket, just rocket. So I think one of the things that you're stressing is be careful, because you could turn around and you could see a situation where we're up 100 S&P handles and then we're right back down 200 handles. And I do think that is something you should be aware of. I think that we're getting to the more exciting part of a market where it's more fun to trade, wouldn't you say? Like, this is a good trading market.
Yeah, it's definitely a good trading market for sure. All right, so time to move on to number 2, just to keep things moving. The UK election and the British pound. Let's not make this as long as the Canadian rant, but we are coming into next week's election, right? It looks
so
pretty
Patrick,
good that the Tories are going to win, right?
Yeah, so let's just, for sure, it looks like Boris is doing well and he's going to win it. Some people have tried to say that that's all priced into the market now and there's nowhere more for the pound to go. Can you pull up my euro pound? That's one thing that I love. And I remember the euro pound was kind of broke out to a level, what was it, like 3-4 months ago? Kind of pushed to a new high. Are you getting the chart?
Yeah.
It pushed up. Remember that? And I was saying, oh no, we're going to prairie dog. So it pushed up to 93, and it's now.
You fucking nailed it.
Well, but now we've got to the point where I'm scared. I like the pound so much, and it's gone so far that I feel like I'm scared that
you're getting the nervous Nellies, eh?
Yeah, I am.
Well,
being
listen,
a nervous
I mean,
Nelly,
if you're up this kind of profit, there's a point where you don't want to give it back, right?
But though, Patrick, okay, let's step back and look at the longer, bigger picture.
Yeah.
It's
on the bigger picture, there was a point when I was trading 70 cents.
Yeah. Or just let's go pound versus the U.S. dollar. It broke out. Like, why don't you practice some of your dark magic there and tell me what that looks like?
Oh, dude, look, that's the first thing that any technician will talk about is a potential double bottom. I mean, obviously, but look, you know what? I mean, it's been, a lot of this stuff has been priced in. I'm in that camp, but I think that the U.S. dollar against the world is the more important trade. And I think that at this stage, like, okay, I understand your euro pound cross, because that thing could still make a move. But I honestly think the next major move in the dollar at some point after the elections, you're going to have a scenario where the pound is going to start trading more correlated to the other cross currencies against the dollar. Right now, the pound is sort of absorbing all of this kind of Brexit stuff and elections and all of this. But once that's behind it, I think it'll start behaving like the basket a little bit more, at least a little more correlated. Maybe it'll be more volatile, but.
So I won't rant, Patrick, but I will tell you this, that Boris is planning on doing a fiscal stimulus. And to me, you got a cheap currency with fiscal stimulus. And I just think it's those things will be kind of an explosive.
Well, he's going to have to do a fiscal stimulus because he has to do something to offset what they're going to lose in being a part of the Eurozone, right?
Well, maybe, but I think it's gonna manifest itself with capital being attracted and their
all right,
stock
let me
market.
give you one last thing because we got to go to number one. But one last thing. I mean, do you not think that there's any risk that this becomes the buy on rumors, sell on news? Everyone's right now rallying it based upon the Tory victory, and everything is now being baked in. And once the election happens, it just sells. You don't think there's any chance of that?
No, of course. Obviously, there's always a chance. I almost never say that it's 100%. But Patrick, I will tell you this: that if you're long-term big money, you cannot buy the pound yet. You have to wait for the dust to settle. So, though, yes, you might get a situation where they rally it up and then it sells off 4 figures on the news. Then the next move from there, I think, is going to be a steady climb higher for the next 6 months, a year, as the big money comes into the UK. That's what I
All right, you heard it here from the macro tourist himself, Kevin Muir. All right,
buy
anyway.
pounds, sell Canada.
I right
British
now will make
stocks,
I'll
sell
make the
Canadian
call.
stocks.
I'll make the call that not a major, like, I'm not going to fight your bigger macro view because there's some things I agree with in principle there, but I do believe that the market is going to sell on news, and that the Tory victory, if it plays out as planned, that the pound is going to mean revert this breakout. Is my view. Maybe we won't. Maybe we're not going back down below 125, but I think it will give back a chunk. All right, number one, Kev. FOMC and ECB. We got back-to-back central banks within 24 hours of each other, with press conferences and all. Lagarde at the helm.
Yeah, that's going to be fun.
Powell not going to move. At least there's the markets are pricing them to stay the same. Correct.
Yeah.
And so, what's your take? Is this going to be a nothing burger? We're going to go through this, and on Friday it'll be like, yeah, that was a waste of time concentrating on this, or is there potential that Powell's going to give some sort of guidance or something that surprises the market? What's your thinking?
Well, Powell is always prone to stepping in it. Like he just he has to put on his boots every time he goes out because he likes to step in shit. But he's gotten better lately. No, really, honestly, he's gotten better lately. I think he's had a couple of speeches where he's managed to not screw it up and stay unstripped. So he might be okay. But Lagarde, this is going to be a big deal for her. This is the first time at the helm. There's a lot of things she needs to learn, and I don't even know I don't even know how she's going to screw it up. But think about Yellen. She had trouble the first time. Powell had trouble the first time. I can't remember Bernanke's first one, but I think
And even
that,
Draghi on his exit was saying something on the lines of that, well, that didn't get the results from the negative interest rates that they expected. I mean, he's basically setting her up to kind of change things up a little bit. I mean, so everyone in some degree or another is going to be looking for any clue as to where she wants to take you know,
the
policy.
reality is it's
And
actually out
if
of,
she
out
just
of her
slips
hands.
up on the words, if she slips
Yeah.
up on the words in one way, I mean, it could be a big mover.
For sure. I agree with you. I think that she's much more interesting than Powell. I'll give you that. Don't like. I think the FOMC is going to be on her. They're going to try everything they can just to stay out of the limelight. He doesn't want to be in the press. But Lagarde, it's going to be, she's going to be under a lot of scrutiny. The potential for error is large.
There you go. All right, let's move on. So, Kev, parting words of wisdom. Notice the blank screen. What happened here, buddy?
I fell down. I got no wisdom for you, bud.
You have no wisdom left. You
got no
used up
wisdom
all
left
your wisdom.
in my rant. Well, actually, you got mad at me for the time. I promise next week to have some wisdom.
All right. Well, so everyone knows Kev this week it has no wisdom. All right.
This week.
So everything you heard him say earlier
Yeah.
has no wisdom. All right.
Okay.
So Kev,
Okay,
that
so
was a good show, right?
It was good. This is the point where our main show ends. But for those who want more Market Huddle, stick around for the after hours interview. And just a reminder that Market Huddle is available on iTunes, Android Play, Podbean, Spotify, and YouTube. Thanks for listening. We appreciate you taking the time to join us and look forward to speaking again next week. I'm Kevin Muir.
And I'm Patrick Ceresna. Have a great weekend.
Take care, folks. Okay. Joining us now in the after hours is Aspen Trading Dave Floyd. Dave, we were kind of chatting before we did our taping, and we thought you were in Aspen, but you actually tell us that you live in Bend, Oregon.
Mm-hmm. Yeah, it's the foreign exchange capital of the world that nobody knows about. People's eyes glazed over if I even consider telling them what I do. People are like, "Okay, you do what?" So,
because Bend, Oregon, is it not the kind of a hippie place? Have I got it right?
Is it a what place? I'm sorry.
A hippie place. A kind of
No, it's actually not. No, but it's a very outdoors town, but not outdoors in the granola way, because I probably wouldn't be here if it was in that way. Outdoor in terms of, like, you got a lot of ex-Olympians here. Everybody's a mountain biker, everybody's a skier, everybody's a golfer. I mean, it's like, this is like Lululemon's probably best area to sell clothing. Everybody runs around. Well, the ladies run around in the yoga pants all day, and everybody's got a Patagonia jacket on. That's Bend, Oregon, and
So are you a mountain biker and a skier?
I'm a huge mountain biker. Both my wife and I are. We literally are. Our house butts up against the national forest, so we literally drive out of our driveway on our mountain bikes, and we're on. I can't remember. Phil, the mountain bike system here is called Phil's Trailhead, and it's nationally known. It's an amazing set of trails that go through the national forest, and that's literally a 3-minute bike ride from our house.
Well, that's great.
So that's what we do in the summer. Yeah.
And I always find that you guys out west, we go skiing and we do some cat skiing in a group of guys. And I always can tell the people from out west because their idea of kind of going for it is just in another league. And the mountain bikers, especially, I find are just scary as hell. And when you talk to people that have grown up like mountain biking out west, they've always like broken major bones and they've had like a friend who's died and stuff. Like, have you got horror stories like that to tell?
Trust me, from my earlier years, I don't ride like that anymore. I ride aggressively, but I don't do all the jumps and stuff. But I was an avid BMX racer and mountain biker when I was younger, and I've got a broken femur, I've broken all my fingers, broken collarbone, broken jaw. I've got plenty of scars to prove it from mountain bike riding, dirt bike riding, and BMX.
There you go. Awesome. That's what I would have thought. You fit the profile perfectly. Okay, and then in the winter, what do? Are you a downhill skier or do you do something else?
We used to downhill ski. Don't do it so much anymore. I mean, literally the mountain's 15 minutes from our house. But we do skate skiing and a lot of snowshoeing. Skate skiing, for those that aren't aware, if you've probably seen it in the Olympics, it's the one where it's like a hockey skating. And you guys are from Canada, you know hockey. You're pushing your skis off to the side to propel yourself forward, just like you do with ice skates. You're just doing it with skis. And it's a great workout. You're doing it on a cross-country trail. And we do that in the winter, and we do a lot of snowshoeing up through the mountains because the mountains here are just fantastic. There's tons of big open bowls that you can go up into. Some of them you need a snowmobile to get into, but yeah, great stuff to do. I mean, I'm outdoors just about every day for sure, whether it be snowshoeing and or skate skiing and mountain biking. I usually mountain bike every day during the summer.
You know,
So
Dave,
I was. Oh, sorry, Patrick. I'll let you go ahead, bud.
No, I was going to say, like, one of the things that I'm jealous of the West Coasters is the time zone thing. Like, I don't know, what time do you first of all wake up to start trading? Are you like a 4 a.m. kind of guy?
You got it. I love it. It's the best time for me because nobody bothers me at 4 a.m. My family's sound asleep. Nobody in their right mind gets up at 4 a.m.
Yeah.
Unless you really love to be in the markets, and I do. So yeah, I get up at 4.
But
yeah.
No, so I'm saying that's amazing because to me, the fact that the markets are closing like at 1 o'clock and sometimes even by 10, 11 in the morning, the market's already more or less done all the moves of the day. You pretty much have your entire day ahead of you still. And the sun is out. Like out here, out east, sometimes like 4 or 5 o'clock, it's like I'm coming home and it's dark outside already. And it's like your day is done. I'm so jealous. I'm like seriously thinking of going out west just to change my lifestyle from around trading. I'm jealous anyway.
No, you're right. I grew up back east. I come from Boston, and I couldn't go back there for a couple of reasons. Time zone for one. I also just like the attitude out here. There's this misconception that everybody on the West Coast is way too laid back. They smoke too much pot. Everybody's just way too this, way too that.
There's no stereotype like that.
Well, I guess nowadays it's okay to have that stereotype because you could just say, well, now it's legal, so get off my back. But what I like about it out here is that people work hard when they need to or when they're best suited to. And what I mean by that is, if you're tied to a desk 9 to 5, that may not be your optimal time to be your best in terms of working or whatever your pursuit is. I know my best times of the day. It's from 4 a.m. till 9 a.m. And then I usually get another kick in the pants like around 7 p.m. till 10. That's when I like to work. I kind of barbell my day. And if I have to work like at 2 p.m, it doesn't work for me. I'm just kind of spent. So West Coast people, it's not all about work. It's like working when you're best suited and when you're going to be able to give it your best. And then I'll tell you what, getting out on a mountain bike ride or getting out on a skate ski or a snowshoe mid-morning, I come back from that, my brain's fresh, and I'm like, okay, now I can do analysis, and it's like a whole new session. I haven't been sitting in front of my screens for 6 hours and then said, okay, now I got to go through my charts again. No, I come back from that mountain bike ride and my endorphins are up and you see things a lot more clearly. And trust me, when I'm on my rides, that's when I come up with my best ideas, whether it be from a business standpoint or somehow the trade clicks for me. I'm like, oh, yeah. So it's really important to get out there. And I mean, I've got the ability to do it because I'm not living in a city.
Yeah, I'm jealous because I was just out in Vancouver and Calgary over the weekend doing a show, and I was up at 4 or 5 in the morning each morning because of the markets and do some webinars and stuff. And it's like suddenly I'm done everything by like 10, 11, 12 o'clock in the morning, and it's like I got the whole day ahead of me, and it's like this is anyway. I love it. That's it. I'm jealous. I'm jealous.
Vancouver. I got to tell you, for the this is actually not only interesting, but given that you folks are, headquartered up in Canada, for the last 2 years, everything that has kind of come around in terms of opportunities, business-wise and relationship-wise for us, or for me here at Aspen Trading, has been from Canada.
Really?
One of my former clients approached me about a business venture, which we're now doing up in Canada. He's obviously Canadian. I've been working with a programmer who is based out of Montreal. I've got a couple of brokers that I work with at some of the big FX firms that have started working with us. And it's just really weird. And I've started spending more time in Vancouver, more time in Toronto, and I enjoy it immensely. I mean, it's such a different vibe. And especially up in Vancouver, holy cow, what an amazing city. You know, if none of you have spent any time there, or anybody listening who hasn't, you got to get there. It's probably got to be the most magical city I've ever been to.
Yeah, it's really nice out there. That's for sure.
You were there one of the the 7 days a year that it didn't rain?
Yeah, I tend to go up there in the summertime, and it's always just amazing. And you know, we actually we always vacation up in the San Juans, usually every summer. And this year we did on the Canadian side. We went up to Salt Spring Island, which
that's beautiful. That's a beautiful area.
It is beautiful, and I'll tell you, the beer that I'm about to crack is.
Oh well, let's crack it. What are you drinking here? You had the big reveal.
Yeah. It is a beer. The company's called Driftwood Brewing. They're out of Victoria, Canada, and they make this IPA. I love IPAs. I love the big hoppy Northwest IPAs, and this one's called Fat Tug IPA. And I had it up on Salt Spring Island. And I was like, holy shit, this is the best IPA I've ever had. So I promptly bought 3 cases and brought it back across the border, and I'm rationing it out. So for because I can't
get them to sponsor the show. We got to.
Yeah, that's right. We got to go. We got to. Someone from Salt Spring send us.
I would love for them to do that. But if anybody who's listening to this out in the Vancouver area, because I don't think their distribution's terribly wide, you got to have their IPA if you like it. It's just fantastic. I almost drank a little too much of it this summer while I was in Salt Spring Island, but that's a different story.
Did you guys rent a cottage, or what were you doing there?
We did an Airbnb for a week, and we basically did much of nothing other than,
awesome.
You know, we hiked and we did stuff like that. But what was wonderful about Salt Spring Island is that it was like a throwback. Not everybody was on their phone. Everybody was relaxed. I mean, granted, most people were probably on vacation, but you could just tell that the island was kind of rushing around and trying to do a million different things. And I tell you, we got back to the States, via ferry. And the minute we got into the mainland in Anacortes, which is north of Seattle, it was just so palpably different. You're just like, oh, yeah, the metro feel again. It was just like, shit. So, but yeah, Salt Spring Island, man, it's amazing. The whole San Juan Islands are just amazing.
Well, and Victoria itself is, I think, one of the most underrated cities. I know everyone says that, only old people go there, but I love it. I think it's just, maybe it's because I'm old.
But you're old.
So exactly.
It doesn't freaking matter.
I'm ready to go there and retire because I love it. It's just a terrific city. I'm a huge fan.
It is a great city. I had a client of mine out of Toronto who, I don't know what the phrase he used was, but he said you're either, there was something about that age disparity. You're either really old or you're really young in Victoria. There was nothing in between. And again, this is just him passing along information. I don't know, but
yeah.
I think it's a great city. I mean, coming in on the ferry into that city, it's just amazing.
Yeah,
no, it's beautiful.
It's beautiful
Okay,
for sure.
Let's talk some markets. So before we talk markets, can you talk any more about your venture with the Toronto guy, and what you guys are going to be doing? And
sure.
Can you? Yeah, I'm curious. How did you meet him? What's your plan? Can you tell us his name and give us some more color? I'd love to hear it.
Yeah, no, I appreciate it. I mean, we don't have all of the details just yet, but I know exactly what we're going to be doing. What happened was, my buddy, well, he's my buddy now. We get along really well. His name's Amin, A-M-I-N, and he was a client of mine for 3 years on my research. And he was a great client. He was, sent emails. He was always inquisitive about, you could tell he was an aspiring trader. He really loved what he was doing. And literally like a year ago in November, so yeah, just about a year ago, he sent me an email. He says, I don't even know if you're going to want to entertain this. He goes, but I'm looking to leave my job at the bank. And I don't want to start a new venture from scratch because I'm not knowledgeable enough in this industry, but I'd really like to be able to partner with someone. And it kind of hit me at the right time because I was thinking, I want to have something outside of just the research business, something that's a little bit more scalable and can be, have a foundational piece put in place. And I was thinking, you know what, I'll talk to this guy. So we started talking, and he met me in New York when I went to speak at the Real Vision conference last February. Liked the guy. We had way too much wine one night, the first night I met him, and we just hit it off. And, ever since then, we've just been talking about it. And what it's evolved to at this point is we're going to set up a money management firm that is going to execute the trades that we do in the research, and also put in there kind of an automated asset allocation model. So what we're going to be doing is basically allocating about 70% of a client's account into a very simple asset allocation model: stocks, bonds, in various percentages, and that'll be adjusted twice a month.
Predominantly through ETFs?
Yeah, we're only using 3 ETFs. We're keeping it super simple. Can't really go into the details of it, but again, nothing complex. We're not going to own like 20 different ETFs in 20 different sectors. None of that nonsense. Very, very simple. And then we're going to take that other 30% of cash and use it with these tactical trades. So we're going to always be quasi long the market in various, proportions. We might be more long fixed income. We might be long higher beta or less higher beta. And then we're going to use the trades in the FX market, 10-year notes, S&P futures, in the occasional stock, to kind of give that additional return that hopefully pushes us well above the benchmark. So we're going to be rolling that out. We're actually literally in the process of setting up the Canadian entity, as we speak. We hope to have it up in January, and we hope to be opening the doors sometime late January, early February. And Amin's mainly going to be, at least initially, he's going to be kind of on the asset gathering side. But he knows markets. He can talk markets, really, really well. And then he's going to kind of continue to learn through our interaction how to kind of really get better at the craft and start contributing on a strategic, on a tactical basis. So, it's going to be good. We've got a lot of good relationships in place. What we're trying to do is build something that is, scalable and can become big, and kind of have the research that we do here at Aspen basically find another home over there, or basically fuel another entity, basically.
All right.
Well, that's great.
Let's talk S&P 500. You trade the SPOOs, but no charts on the chart deck about SPOOs. So you got to tell me, what do you think's going on here in the S&P? Are we going higher here?
We are going higher, and I'll tell you what, I'm going to sound really simplistic here, but I look at this chart that's up right here, and I'm just thinking, I'm going to sound like a complete moron, but just buy the goddamn dips. The market's not going lower. I mean, there's nothing on the horizon that suggests we're going lower, and the tendency, at least into the end of this year, is from a seasonal perspective, we're going higher. I think once we get above this 3160, forget about it. I think
where did your Elliott wave and extensions all lead to? Are we going 33, 3400 in your mind, or like where's your measurement go to?
Well, I'm glad you asked that, because I got to be honest with you. When you look at that chart, for me, I get really, on a longer term time frame like this, I have a really hard time labeling it. It seems like almost a waste of time, because all the damn things tends to do is go up. So I'm keeping a very tactical approach. I mean, yes, I have long exposure in my own portfolio, but from a trading perspective, I'm largely ignoring a lot of the previous price action. I'm just trying to focus on what's happening right now. And I think 3,200, 3,300, that's certainly within reason. I'm going to go out. I'll go out to the end of the year, and I think once we eclipse 3160, my sense is that the market, meaning money managers and whatnot, are probably not long enough, and they are not going to want to deviate from their benchmarks too much. I think we're going to have a melt up into the end of the year. That's how I see it.
And now, hold on a second, because I have to turn this. I'm going to turn this around on Kevin here, because Kev, I have a feeling that you're going to give me a prairie dog here. Are you on the other side of this? Are you?
No, I don't. I actually think Dave could very well be correct there. I'm not going to say that we're going to prairie dog for sure there. This thing has got a lot of momentum, and there's still a lot of people that are underinvested. But Dave, I have a question for you. You've been in the market a long time. And this summer, you kind of alluded to it, the fact that we had a little bit of a scare with the yield curve inversion. And I would say that it was more than a scare. I was flabbergasted at how the financial community talked themselves into believing that a recession was just around the corner. And I was wondering if you've
I still
ever
talked myself into that.
Yeah,
by the
well,
way.
you always think there's a recession coming around just around the corner. Have you ever seen a situation where it is flipped so violently and so adamantly and convinced so many people only for them to be proven wrong? Like, to me, it's just it's astounding how many people were looking for that recession, and it's like almost like they created the inversion of the yield curve themselves.
No, I think it's a really good point. And I mean, I think it's on some level, it's a logical conclusion to draw because of where we are in the business cycle. I mean, we're 10 plus years into this. I mean, uncharted territory for sure. But I think what a lot of people didn't realize, and again, I'm not to say I was, I was leaning towards that at one point. I'm like, yeah, yield curve inversion, not good. And then when you really started digging into it from a quantitative standpoint, not all parts of the curve were inverted. And I don't remember the exact details at this time, but after kind of digging around a little bit, I'm thinking, you know what? This is not what most recessions have evolved from, at least in terms of the yield curve. And there's another chart I should have sent over, and I don't know if you've got your Bloomberg terminal up, but I'm always looking at the spread between high yield and investment grade corporates and the spread between those. And it's like clockwork. As that spread continues to decrease, the S&Ps continue to move higher. Well, that spread is continuing to decrease, and that has been basically like money, so to speak, for a very long time. So until that changes in my book, the S&Ps are going to go higher. But going back to what you were saying, it's also the kind of the news cycle we live in nowadays. I mean, it doesn't seem as though most news, whether it be on the political front or the economic front, there doesn't seem to be a really good deep dive understanding and analysis of what people are talking about. It's like, oh my God, this will make for great headlines and be great for ratings. And
right. But I think
that might just be it.
I think that it's actually the financial news kind of within ourselves, like even like the podcasts, Twitter, all these things, we almost feed upon it ourselves. And I think that you look at what happened in the Eurodollar market, I think some big hedge funds just kept pushing and pushing. And as it went higher, they convinced themselves, that there was a recession coming because there's the curves inverting. But the reality is that they're the ones inverting the curve. And not only that, we never had a curve invert, with them lowering rates, which is what happened. And I guess I don't want to sit around and say that it was an easy trade by any means, because as you're getting run over with all this kind of recession talk and stuff, I just kind of shocked at how much the financial community is convinced, like almost like to the point where people are telling you you're a fool if you don't believe this. And you should have seen, like, I got bearish on bonds, and you should have seen the hate mail that I got. Like, it was just
half it was for me.
Yeah. And I think the world's changed. I think it's kind of funny because I think that a lot of ways, to some extent, guys like you that are just trading the charts is what you have to do, because the reality is that the fundamental guys are talking themselves into things that aren't even true.
Well, I think, it's one of the challenges of fundamental analysis. It's a horrible timing tool. You can spin a nice story, but if the price action doesn't really support it, it's just that, a nice story. One of the things we didn't talk about, and I think it kind of dovetails into what you're talking about, is that there's too much information out there. It's ubiquitous. Everybody with an internet feed can get not only nonstop opinions about the market, but also nonstop data. And I think on some level, it's actually harmful unless you know how to kind of sift through it or tune it out. But it is interesting that what you brought up, I actually hadn't really thought of it about how wrong that was. And I think that leads to why I still think people are not positioned properly going into year end, which is why I think at minimum S&Ps end up higher than where they are right now. What happens in 2020, that's harder to know because Trump could say something, maybe the economy finally does sputter, but I don't know. It just doesn't look like it's doing it, at least at this point in time.
You know, I like to give Patrick a hard time about his technical analysis. I call it voodoo magic and the dark arts and stuff like that.
Dark
the dark
magic.
Art, yeah, the dark arts. But the reality is that if you go look at the true legends of the hedge fund community, guys like Paul Tudor Jones, they made their money by following charts. And, you know, the fundamental guys that just sit there and try to tell you that it has to be such because they know the answer are oftentimes not the people you should be listening to, because at the end of the day, the price action is all that matters. We can all have opinions about where we think it's going fundamentally, but the price action is actually the true arbiter of what's going to happen. And I'm sympathetic to the idea that more and more people should probably start doing more technical analysis. And I saw something Tudor
Don't ruin
Jones
it for
said,
everybody.
Yeah,
no,
I saw something Tudor Jones said something about this the other day, that there's not enough people that are doing that, and that they're going to get killed in the next market correction because nobody knows how to read a chart anymore. Anyways, I thought that was interesting.
I will push back on that, Kev, because I believe the market. Look, if you think about order flow and you think about how we all participate in the markets, if everyone started to do the same thing, it would stop working, and you don't want actually everyone doing it. It's like modern portfolio theory. It's like once everybody starts diversifying and following all of it, then all of it stops working the same way that it was intended to work, because all of the money is all crowded into the one way. I just think that technical analysis is a phenomenal tool, but it shouldn't be that everyone should be using it, because it would ruin it for us that are using it.
There we go. Patrick wants to save it for himself.
No, but you know what? It's just you need to have an edge, and it's better the more people don't know about it. And anyway, but listen, I want to push back. Stop for a second. I want to go back to this, okay? Because I'm tired of you shitting on the fucking yield curve for a second.
He's talking to me, David. He's talking to me, not you. Don't worry about it.
Yeah, I'm talking to Kevin. Well, and you know what? Listen, we'll throw Dave in here. Why not?
Yeah.
He's almost Canadian. You know, like but listen. All right, like you're trying to like talk about everyone calling recession, but look, in 2006, it was 2005. Sorry, not 2006. The yield curve started to invert, and then you had it steepening a little bit right over here at the start of 2006. And this, I'm envisioning hearing someone spewing the shit that came from your mouth right there. Right? Like, and yes, you know what? It continues to flatten and it continues to do nothing for an entire year. But there's no market timing to the yield curve. Just because it inverted and everyone was crying for recession, just because they thought the recession would start next week and it didn't, doesn't make it less valid. This is a thing that happens over multiple years, and we've only saw the inversion begin. Like, I mean, we could be in 2021 still talking about the steepener. I just think that you guys are not you guys. You know, like as far as I'm concerned, you know what? Yes, we've had this steepening starting, and but I honestly think it could still be like it doesn't mean that a recession has to start next week or next month, and that anyone who called it there is wrong. It's just, I think that if you were actually believing just because we had an inversion that a recession was imminent, that's the mistaken assumption, isn't it?
Well, yeah, but those people went and bought long bonds and sold their stocks on all the kind of the hype in the news media or in the blogosphere of the yield curve inverting this summer. Patrick, remember the reach for yield? It was, unbelievable.
It was.
And people were selling their stocks and trying to lock it in, and meanwhile stocks have raised higher and bonds are down. Like how you like them apples? Like that's not working for you. So yeah, maybe we're still going to have a recession in a year or two. The reality is that nobody knows, because we don't know what the Fed and what the economy is going to do and what the fiscal policy will be. But I guess I just wanted to comment about, get Dave's opinion about how the world has changed, because the last time we had a yield curve inversion, probably nobody talked about it. Or like there was like 7 guys on Wall Street that might have mentioned it. But it's like
maybe 6.
No, really. Yeah, like it's something that's gone from just a few, people watching it to something that's on the front page of every, news headline. And here's something for you, Dave, as well. Like I found that that the internet has been a great tool for helping people learn about trading and finance, but it also has been a great tool for the people that have just been peddling kind of fear. And I think there's a very famous, website that makes a lot of money off of doing that. And that website, although it's entertaining, it probably hasn't helped you very much.
No, it hasn't. I mean, God, we could go so many directions with those 3 bullet points alone, but I'll just touch upon them briefly. But yeah, too much information, too much bearish information can be harmful. And you've got a lot of other people out there, masquerading as quote unquote professionals, just slinging a lot of shit around. A guy who steps off a private plane and says he has 3 simple chart patterns comes to mind, but I don't know. I don't want to really go there. But, going back to the yield curve thing, you're right. The average start of the recession is a year or more out after the yield curve inverts. So you're absolutely right that we could still be in a recession by the end of 2020. And, who knows? Maybe we are. This is what you have to do as a trader. You got to start looking for the clues down the road, using the technical analysis, using all the other things you can look at, quantitative analysis, common sense. I would say regarding the charts, and I know I'm just kind of hopping around here, but I'm kind of briefly touching upon those bullet points you guys were chatting about. The nice thing about, even if more people were to start using technical analysis, everybody's going to use it in their own subjective way because it's not completely A, B, and C or black and white. So if anything, it might end up causing some distortions that a trained set of eyes might actually be able to take advantage of.
For sure. I agree with you there. And it's like the same thing with indexing. Indexing at its extreme doesn't work, right? Like the reality is that if everybody indexed, there would be nobody pricing in individual securities, and therefore the market would break down. But as more people index, this is my point about indexing, is that I kind of push back and say, as these people index, it gives the fundamental investor much more opportunity. It's all of a sudden those stocks that aren't part of the index are cheaper. So if you're a long-term investor, oh, sorry, Patrick's going to push back again. Go ahead, Patrick.
No, all I'm just saying is that all you're identifying is that there's value stocks out there, and shit's going to be cheap.
No,
but
if you're truly a truly a long-term investor, Patrick,
dude,
you're
going to be dead in 20 years. No, just kidding. I'm not saying it.
No, but honestly,
how long is long term?
But like if you're an allocator of long-term money, like if you're a pension fund, you should be happy that you should be going out and picking active managers now, because as more people index, it makes it easier for the active managers to pick up cheap stocks.
I completely agree.
Yeah, like you're from Bend. One of Jesse Felder's there. You guys must hang out together at the
I know
bar.
Jesse. Yep.
Yeah, you're the only 2 finance guys in Bend probably. But I go back to he had a great point that I thought was just so smart, and he talked about the fact that if what is it? I guess if you're a founding, if you start a company and you're a founding shareholder with a large percentage, then oftentimes you're not eligible for the index. So you're somebody that owns 30% of a company and you're running the company for yourself, but it's, the other 70% is public in the public markets, then you're not eligible for the index. So those stocks are trading now at a discount because basically they're not getting the buying from the indexes. But the thing is that if you look at the long-term kind of founding shareholders, actual economic performance or business performance of founders as CEOs, they actually outperform over the long run. So Jesse came up with this list of 20 stocks or something that have founding shareholders that trade, that are public, and that these things trade. And he's like, I'm going to buy these. And I thought that was the most brilliant idea. And I thought to myself, this is the kind of stuff that occurs when you get distortions from too much indexing. And I'm just like, bring it on, because smart guys like Jesse are going to figure out ways to make money even with when everybody else is chasing something.
Absolutely right. There's always an opportunity somewhere. It's just the inquisitive and the curious will sniff it out. You guys were talking about Paul Tudor Jones a while ago. That guy still actively trades the book pretty much every day. One of my clients, oddly enough, he used to work for Paul Tudor Jones. He's at Citadel now, And he gets my research, which blew me away. I was like, wow, my research is at Citadel in London? Wow, fantastic. And I had coffee with him while I was out there, and he's like, oh, yeah, that guy trades every day. He's actively part of the book. And because that's how he defines his edge, by being in there and finding those anomalies. And there's always going to be guys and gals like that out there that are going to figure out how to generate alpha, for sure.
Right. And to be fair to Paul, like, I don't know about you guys, but I would be 75 years old. I still want to be trading. It's kind of like what I always was meant to do.
It's in all of our blood. I'm pretty sure for all three of us, it's like, I
It's
don't
not
know that when I'm on vacation and I can't watch the markets, I feel disconnected. That's like unplugging me from the matrix. It's like, I feel like I start getting itchy on the skin. I don't know what to do with myself. I need to refresh the quote screen.
No, I'm with you. It sounds like we're all in the same boat. I love what I do. It doesn't feel like work. And when I'm away from it, like sometimes I'm like, Jesus, Monday yet? Or Sunday afternoon. Is it Sunday afternoon yet? So
okay. Well, Dave, we should probably let you go do some of your cross-country skiing. And I just want to, we'll give people another chance to, why don't you tell everyone where they can find you and learn more about what you offer. And thank you again for joining us.
Yeah, sure. Well, I just encourage everybody to come by the website at aspentrading.com. You'll see a big intro offer opportunity right there if you want to get 30 days of our research to see what we are all about. One of the things that we do really well is we're transparent. All of our trades are listed there. So there's no magic to what we do. We just do a really good job at technical analysis and quantitative. So if you're looking to kind of get trades and research fed to you so that you understand the process, maybe make 4 or 6 trades a month, we're probably the firm you should be taking a look at. And we're good guys. We're fun. So, you should definitely come by and check out the website and sign up.
And Dave, next time you're in Toronto, give us a big heads up and we'll do a shout out at the show to do a market huddle meetup and we'll go for beers. I
would love to do that. And I will, and there's no doubt that I'll probably be in Toronto in January or February for sure. So I'll give you a heads up. Try to make sure it's warm, like not super blistering on there.
Oh, good luck with that.
Yeah, I know. All right, gents, have a great weekend. I really appreciate it.
All right. Thanks again for coming on, Dave. Take care.
Thanks, Dave.
Bye-bye.
Okay, Lena, hop on.
Oh, wow. That was a really nice wrap-up.
You like that, eh?
Yeah, that was really nice.
Yeah.
That was quite the rant.
I know, I went a little bananas.
I didn't mean to cut you off. I just thought
no,
funny.
I just realized that I was like, I had gone long. You know what? It just kind of makes me mad, though, because it just seems to be the people that were the most bearish on Canada at the kind of at a point when they shouldn't have been, and now they're all giving up, and it's like, to me, the trade's becoming more clear. But let's not go on. You don't need to hear me.
No more.
Let's talk about this beer. I didn't realize that this is my buddy's beer got me this. Andy's beer.
You should have done a shout out for the Niagara region.
Well, let's do it again. I love going to visit Niagara region. I love going to Niagara on the Lake and maybe going to Cow's Creamery for an ice cream. How about you guys?
Oh, I absolutely love going to the falls. It's a great place to be.
We sound like Jim Grant when he does his podcast.
Talking about mattresses?
Yeah, I love the guy. He's like this very serious, very erudite speaker, and he sounds so smart. Like literally, he sounds like the smartest guy ever. And then halfway through this beautiful speech about interest rates, he stops and he says, "Hey, Patrick, do you know what I love? I love my Casper mattress." He's awesome. Like, he's awesome how he does it with like a kind of a jokey face, and I just love it. Anyways, let's talk about this beer. So I'm going to, why don't ladies first? Lena, tell me what you would rate this.
I think Patrick was going to go first, but
yeah, Patrick was jumping all over that.
I would give this probably an 8.9.
Oh, nice. Okay. Patrick?
Well, first of all, while I'm giving this a rating, I just want to do a shout out to our huddlers out west.
Oh,
so I
my
was
goodness.
in Vancouver.
Yeah.
There's a picture up on our YouTube page there. But we had a great meetup. I had two Huddle sessions, drinking beers within 2 days apart. So I had so much beer that it's I'm still hungover now. But anyway, it was a great opportunity to meet so many of our listeners. Just wanted to shout out. It was such a pleasure meeting all of you. And Kev, they all love you out west, buddy.
I know that's because I'm surprised the Vancouver people like me because I know why the Calgary people love me because I'm big, let's get the pipelines rolling. But the Vancouver people, you know what, I do love Vancouverites. I really do. I'm a prairie boy. I'm not very good with the rain, so I make some jokes about that. But you guys can make jokes about the fact that it's so bloody cold in Winnipeg. And you know what, I'll kind of annoy our 5 listeners from Winnipeg. And I'll make a joke about myself here. I'll say there are some that are born into greatness. There's others who have greatness thrust upon them, and then there's others who stay in Winnipeg.
The joke that I've always heard is so mean.
Too.
But the joke that I always heard is like all the trees in Canada slant inwards, and that's because Winnipeg sucks.
Oh, that's mean. And you're not even from Winnipeg. You're not allowed to make that joke. Take that back.
I take it back. Fine.
Take it back.
I didn't make the joke. You started it with saying a joke, and I was like,
I'm allowed to make the joke.
I'm
from Winnipeg. I'm from Winnipeg. I'm allowed to make a joke
It's a very
about that.
sensitive subject, you know?
Yeah,
God,
Patrick.
I'm so sorry. I am so
Crossing
sorry.
the line again.
What if I started talking about Etobicoke or wherever you live?
I wouldn't care.
No, I'm just kidding. Okay, let's talk beers. What are you going to rate this?
Yeah, this was a delicious beer. You know what? I'm with Lena. You know what? I'm not going to leave her alone. 8.9. You know what? I don't want to try a toppler number. This is a sessionable beer. I would be able to sit down and drink 4 or 5 of these. It's a winner. It's a good one. I like it.
I'm going 9.2. That's how much I liked it.
Whoa.
Really?
Yeah.
That's a really high score for you.
Yeah, I really liked it. It was like a perfect Canadian beer.
Yeah, it's nice and crisp.
I like it. So, Lena, you got to tell us, how was Hotlanta?
Hotlanta was hot. It was warmer than expected. It was like 20 degrees when I was there. So
wait, you got to tell our American listeners what that is.
20 degrees. Language. It was like, I think it was like 70 to 73 degrees Fahrenheit, which is, for us, that's summer.
68. Yeah.
Or 68 to 73, something like that. It was just hot. It was hot.
It's hot.
I had a leather jacket and sweaters because I left from here, and then I get there and I see people wearing sandals and shorts. It's Thanksgiving weekend.
Yeah.
I'm all bundled up and people are wearing shorts and walking around.
So when you go to the Caribbean in like wintertime, and do you ever just say, screw it, I'm not bringing the jacket, I'm gonna just live with it, and so you go and you put on the shorts ahead of time and you just basically go to the airport in minus like 20 in sandals and flip-flops and shorts?
I've done that.
I do that all the time. I don't want to carry the jacket around, and you just freeze. It's some, but then you don't have to haul your jacket around.
That's true. That's very true. But I was talking to someone about this the other day about aging and getting cold.
Yeah.
So, you go downtown Toronto, like Bloor and Bathurst area, there's some seedy bars around there. There's a bunch of young girls, going out on a Friday night or something in the middle of winter when it's like minus 20 degrees outside. What is that in Fahrenheit? I don't even know. And these girls are all dressed in, shorts or short dresses with little tights on and a leather jacket. They're not warm. It's freezing outside. And I used to be one of those girls until one point you're like, I don't give a shit about what I look like. I just want to be warm. So that's when I realized, this is adulting.
Do you know what? After I saw how much trouble Peloton got in trouble, or how much trouble they got into with their video, I think I'm just going to leave that one completely alone.
I'm just going to talk for myself. I've driven down south where I'm leaving Toronto and it's minus 10, and I'm literally in just a long sleeve shirt. I won't even bring a jacket because it's just gonna take up too much room. If I ever got stranded in the car and the car ditch, I'd freeze to death. But it's I'm just not going to bring a goddamn winter jacket with me down south. Forget it. And it's like you just jump in the car, turn on the heaters, and that's it. You're gone. That's
Gone.
I've done that before so many times. Like I won't bring a winter jacket with me on a vacation. Fuck it.
I'm with you. Do you know that in like when I go cat skiing, often the guys will have a sleeping bag and a whole kit in their car because of avalanches and bad snow. Because they regularly have to sleep in their car.
That makes sense.
Like it happens like once or twice a season on them. They're like, oh no, I couldn't make it. I had to sleep here. They just pull over and sleep.
Wow.
Yeah, so they all do that. They like all when I go on my trips, they all have like full on sleeping bags and stuff. Little Coleman stove. No, I'm just kidding.
All right.
Okay. Well, anyways.
That was a good show.
Yeah, apart from
Dave
my
was
rant,
great.
I won't. Oh, Dave was great. He's a super nice guy. Super nice guy. I hope he comes for a Market Huddle meetup.
Yeah, for sure. Now we're gonna have to do a little meetup to settle a few bets. We're gonna have to find out when. We're gonna have to send an invite. We have a short list of huddlers that are gonna get in on the fully paid evening on your tab.
Oh.
That's right, for my inflation bet.
That's right.
It was terrible. At least the inflation means my beers are going down in price. Not. I'm going to take you to like Loblaws, and that's where we're going to drink out in the parking lot.
Free beer is free beer.
That's right. We bought 2 cases of Loblaws
in some like fucking bus stop. We're drinking like out of a brown bag, fucking 6-packs. It's on Kevin. I didn't lie. I was buying beers for all the huddlers. So.
Yeah, I did say it was going to be warm. I didn't say it was going to be in a bar. Technically, I know you've just driven from Detroit to see this. But okay. Well, anyways, we should let you guys go. Have a great weekend.
Yeah. It was great. It was a great show. But all right, listen. We'll reconvene next week. It was great. Thanks everyone. Have a great weekend.
Thanks, guys. Bye bye.
Yeah. Cheers.